In Europe, and the euro just on the back foot a little bit this morning, 108.10. So we are seeing a little bit of weakness just in the last hour coming into the euro. And I put in here the UK gas futures price. This is the UK benchmark, not the European one. The European one was open yesterday, spiked up on talk of strike action by Australian LNG workers. We're still monitoring that story, and this is what we see in the UK market as a result of it, as we play catch up on various UK assets. Quick look at futures then, and the European futures picture looks kind of positive, in particular the London market. As we say, though, is playing catch-up with yesterday. The CAC 40 yesterday really benefiting the luxury sector in particular from more positivity around China, looking to see if that passes through into London on maybe the basic resources side. DAX futures, CAC futures, though, also pointing higher. So another day of gains perhaps attached tangentially to the Chinese narrative, maybe also around the lower yields environment, certainly on treasuries and more European bond markets as well. We had a little bit of pause on that higher yields August story that we had been talking up to this point. Let's have a look at how we open up then on European equity markets, and we are seeing, as predicted, the FTSE 100 bouncing this morning, catching up with those gains of yesterday that we saw elsewhere. So the FTSE up by 0.9%, a bit of upside on the pound and a bit of weakness that we talked about on the euro coming through in that second column. The dollar is actually flat today. We see the German DAX also opening higher, the French CAC 40 also opening higher. So another day of gains perhaps then, as I say, around the China story, around a pause in yields, maybe that giving some room for markets to gain as well, room for some risk appetite. But we're really waiting for a lot of crucial data coming out this week. We'll get Eurozone inflation, we'll get US PCE, we'll get US labour market reports, so all of that will certainly be in focus for investors. Let's roll on and show you the sector picture. With that kind of move in London, we would be expecting to see basic resources not doing too badly, along with energy stocks. Well, there's basic resources up by 1.9%, so that's certainly something that is driving sentiment today. Retail also up by just shy of 1%. Maybe this to do with what we were talking about with Sophia earlier, and also Joe Easton from our equities team, the fact that the BRC grocery prices, yes, they're still rising with a 6 handle, but that is lower than they had been. So that's certainly better news perhaps for retailers and for consumers as well. This is the picture then across European equity markets, up by 0.6%. The FTSE plays catch up this morning. Let's dig into some of these market themes affecting the trading day. Sophia Horta-Acosta joins us from the Markets Today blog. And let's start by thinking about where we are on the sort of higher rates for longer story then, Sophia, because for the early months of August, that seemed to really dominate our thinking. Just in the last days, we've seen a little bit of a pause maybe in that with the yield story. Certainly we saw higher yields on Treasury auctions yesterday, but Treasury yields this morning looking a little softer, and the European yield story a little softer. Where do we stand then on the higher rates for longer story?
A little bit of a calmer start to the week, Anna, that's true. I mean, the US auction, it's really showing what the repricing in markets, you know, the effects of that after Powell's speech in Jackson Hole. Really, the higher for longer narrative is really becoming entrenched, but markets seem to be okay with that. The auction results were quite strong. There was demand for treasuries at those levels, so the read on that was quite positive, actually. And we're seeing that positivity kind of feed in through the session today. The key theme, though, I think today will be quiet. For us, it's 3 p.m. That's the key, you know, for where markets will go. That's when we get the latest job opening data from the US, and that is really setting the tone, Anna, for where markets will go. August was all about higher for longer. July was all about soft landing. Let's see what September brings us.
Yeah, really interesting. We had a conversation actually in the last hour of the programme with Geraldine Sundstrom from PIMCO talking about where the supply story goes and whether demand can sort of stand up to the level of supply we might see coming through, in particular at the long end, she was saying. Let me ask you about food prices and back to the UK sort of specific side of things. It seems that retailers doing well this morning. We've had the BRC food price data out suggesting, what, a little bit of relief for consumers in terms of the prices they pay?
Yes, the bar is really low for good news, isn't it? I mean, food price inflation, groceries coming down to 6.9%. That's a slowdown, a pretty sharp slowdown from the prior month. So this is good news. This will kind of feed into the narrative here that UK consumers are taking notes, which is inflation is slowing, wage growth is growing, is increasing, is speeding up, and people feel a little bit better about their finances, their personal finances. So a little bit more optimism there. Whether this changes the picture for what Andrew Bailey and his team will do September 21st, I think there's still so much data for us to digest between now and then. There's inflation and the next wage print due before then. But this will really set the narrative and the discussion, the debate in September, Anna. This is what markets will obsess about. The rate path, the higher for longer, and will we get a pause here in the UK?
Yeah, absolutely. So the impact on the Bank of England, really clear, really interesting to watch, isn't it? And interesting to see how this is playing out in stocks. We are seeing some of the grocery stores moving a little bit higher, but actually it's other retail that moves higher. I suppose if you have to spend less on fruit and veg, you have more money to spend on shoes. That would be the conclusion of today's trade on the UK assets. Thanks very much to Sophia for thoughts so far. Sophia Horta-Acosta from the Markets Today blog. You can find that blog by going to the front page of the Bloomberg UK website, click through to it from there, or you can type TLIV Go on the Bloomberg terminal. Here's what we're looking out for then today. The UK Foreign Secretary James Cleverly will be in China for talks focusing on Russia's war in Ukraine, hot on the heels of Gina Raimondo with the trade team, of course, from the United States. Now, at 1 p.m., we'll get Mexico GDP figures. Bloomberg economists see activity rising 4.6% year on year in the month of June, but a recession in the US is the main risk to growth in Mexico. Then at 3 p.m., US consumer confidence data will be released. That'll be closely watched. And before the US market opens, we get Best Buy second quarter earnings, which, along with the consumer confidence data, will give us a really interesting picture of the strength of the US buyer. We'll also get some indications of house prices, which Mark was flagging a little earlier on. Now, coming up on the programme, we'll dig deeper into how UK grocers are moving as shopping bills in Britain see their slowest increase in almost a year. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labor market is still tight.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, Friday on Bloomberg Television and Radio.
This is Markets Today. We are 9 or so minutes into the European trading day. London playing catch-up. It was closed yesterday, so we are seeing bigger gains on the London market than elsewhere. Catching up with the gains we saw in Paris, perhaps, so up by 1.3% on the FTSE 100. Elsewhere, we see more modest gains, but they are still gains. Another day of positivity, another day of risk appetite, it seems, for stocks. Let's check in on some of the individual stocks that are moving. Joe Easton from our equities team has a briefing. Joe.
So NN Group over in Amsterdam is the best performing stock on the Stock 600 at the moment, up around 8%. The insurer did report a rise in some of their key premium numbers in terms of their revenue for the last quarter. Morgan Stanley saying that this bodes well for potential shareholder returns in terms of buybacks and also dividends as well. Telecom Italia also ticking higher. The Italian government has signed off on a deal for KKR to purchase the grid network from that company, and the Italian state will have a stake in that deal as well. And then Standard Chartered, which we had in stocks to watch, selling their aviation finance business, that one reopening after the long weekend here in the UK, up around 1% in early trading on the London market. Then in terms of Heineken, that one was moving higher, so that one upgraded to overweight over at JP Morgan, who see 20% upside for the Dutch brewer. And Britvic in the drink space as well. That's the best performing stock on the FTSE 350 at the moment in the UK, with the drinks firm upgraded at Barclays, who goes overweight that one for the first time in 2 years. They're positive on those. I'm sure those companies both did some good sales over the long weekend. Now, Solaria Energia over in Madrid, up 5%. A new buy rating over at Citi, a double upgrade from Cell. They say some big projects over in the Spanish renewable space will boost that stock. And then in terms of real estate, Grand City Properties, this is a German real estate firm, soaring 7.6% as Goldman Sachs turns a buyer on that one. So a couple of big movers in terms of the rating changes driving those stocks higher in early trading. Finally, just a quick look at a couple of the UK sectors in focus. We mentioned that data from the BRC that you also spoke of a moment ago. So the grocery sales still coming up, the prices moderating in terms of the price rises, but we're seeing those shares coming back up. As you said earlier, the London market reopening, so potentially a bit of catch up. Then EasyJet and IAG still higher despite ongoing disruption at UK airports. That's still continuing according to the BBC, given the technical glitch at the weekend, but not seeing too much of a reaction at the moment.
Yeah, interesting to see real estate doing quite so well then, Joe. We've got the real estate sector up by 1.7% this morning. Joe, thank you very much. Joe Easton from our equities team. Did I stop you too early? Were you going to talk about watches of Switzerland?
Just because it fell so much on Friday, down 20%, a 5% gain this morning, so potentially coming back, a bit of a bounce in that one. That one fell, obviously, given that Rolex purchase of the retailer. But as I say, seeing some of those losses decline, trimmed this morning.
Excellent. I'm glad we doubled back to cover that one. Joe Easton, thank you very much for the briefing on some of the stocks on the move this morning. Let us get further thoughts on the UK market and broader stocks. Sophie Lund-Yates joins us, equity analyst at Hargreaves Lansdown. And Sophie, I want to start actually with what we've seen on the retail side. We've got those BRC numbers that Joe was talking about there, giving a bit of a boost to some of the grocers, but more so maybe to other retailers. If we spend less on groceries, more on other things maybe. What do you take away from this BRC number? I mean, a handle of 6% growth in grocery prices is still way beyond where the Bank of England would like it to be, but it's moving lower.
Hi, good morning. And unfortunately, you're completely correct there. And I'm not going to try and be overly negative. You're right, things are moving in the right direction. But grocery inflation or retail inflation of over 6% is still absolutely, phenomenal. This kind of speaks to the times that we're in, that we're hailing this as actually some quite good news. But you're right, the trajectory is moving in the right direction, albeit perhaps, a little bit more slowly than consumers would like. But I do think still what we are seeing is overall optimism in the UK consumer in particular. We have the highest savings rates compared to our peers in the US and Europe. And that means people are already, as much as things are certainly difficult in certain corners of the economy, overall, consumers are still actually feeling relatively okay. And you're absolutely right, spending power for other areas of retail, potentially, I'm looking at areas like luxury and things like that. I think potentially this does have some really quite positive read across, absolutely.
Yeah, we saw luxury getting a boost yesterday, actually, from some of the China news flow, didn't we, Sophie? So in a global perspective, that got a pop yesterday. Let me ask you about the post-pandemic savings pot that UK consumers have then, because the US savings pot has received a lot of attention. There was a Fed report out recently that suggested that US consumers would have depleted that sort of stash of savings by this quarter, by later on in this quarter in the United States. Do you say then that the UK is sitting on a healthier pot there, and that could support consumers as they face up against still elevated inflation and soon to be elevated mortgage payments?
Fundamentally, yes, I am saying that. The UK consumer as it stands today is more resilient, I believe, than the US, because we are sitting on a higher savings or higher savings pots, larger savings pots. But the problem is that what I'm not saying is that is going to remain the case. That is already starting to be chipped away at. And actually, the mortgage situation, you look at the personal finance anxiety in the UK, that is quite high. So as more people roll off things like their fixed mortgage rates in the coming months, and we look towards the end of this year, I do think potentially kind of looking into Q1, Q2 next year, but I think certainly by the midpoint of next year, there is going to be further pain for UK consumers. But I do think there's enough in the tank, as it were, financially at the moment for things like, consumer discretionary, like retail, to be doing reasonably well and to have reasonably resilient and robust performances at the moment.
Okay, so we'll monitor that pot of savings and, as you say, the threats around mortgages. More broadly then, Sophie, which are the equity markets that you favour at the moment? We were discussing in the last hour how the ones that have been highly valued and look a bit stretched to some people are in the US and around technology. But just because things are cheap doesn't mean they're going to become more expensive. So where are you focusing your attention when it comes to equities?
Absolutely, I do think, unfortunately, I will have to agree with a lot of people here, and you probably won't be surprised to hear me say that I do continue to believe that there is absolutely phenomenal opportunity surrounding AI and the excitement there. But I think looking kind of away from that area, I think telecoms in particular need a little bit of attention. They are often quite unloved, but there is some really quite interesting, perhaps more sensibly valued propositions going on there, particularly when we look at Europe. And also, I do actually think that travel more broadly. I've been saying this for a while. I think travel is incredibly interesting at the moment. When we look at the way that travel is being categorized by households, we look at the numbers that have been coming out. Actually, it's being treated at the moment like an essential spend, not a discretionary spend, and that is an absolutely huge shift that we've seen since the pandemic. So I think that looking there, there's some compelling stories going on too.
Is that classification, though, as essential, is that vulnerable to the higher interest rate environment, Sophie? And does that fade, do you think, for travel stocks?
Yes, so I'm going to potentially contradict myself here. There are kind of two stories going on within the sector. I think for the stronger players and those that have worked incredibly hard to get both their value proposition, so they're getting their pricing right, but also what they're actually offering has really massively improved as well. I'm thinking particularly about some of the more nimble airlines. I think that they're actually in a position to stand up to the pressures that are coming through incredibly well. As people, I do think they will still continue to prioritize experiences where they possibly can. But of course, as we do see households come under enormous pressure from rising interest rates, I do think that there are some weaker names in the sector that will absolutely, I do think they're going to struggle. But within that, as I say, there's been some really big work going on for some of the big names to boost their propositions, and I think they're still in a position to benefit.
Sophie, thanks very much for the analysis. Sophie Lundy-Yates, equity analyst at Hargreaves Lansdown. Now, for some corporate news, Bloomberg has learned that Goldman Sachs' sale of its consumer lending unit, Green Sky, is entering the final stretch. Apollo Global Management, Pagaya Technologies and Sixth Street are among the finalists working on their best and final offers for the business. And it comes as Goldman plans to sell its $29 billion investment advisory business to Creative Planning, with no sale price disclosed yet. Bloomberg's Sue Keenan has the story.
This is a move that underscores Goldman Sachs is refocusing on what it does best, managing the money of the ultra-rich. The sale of the investment advisory unit is related to failed forays into consumer banking and efforts to market its services to the mass affluent class, the mere millionaires next door. Goldman has now agreed to sell the investment advisory business that grew out of its purchase of United Capital just 4 years ago. That unit has $29 billion, and Goldman not revealing the price, but says it expects to recognize a gain when the deal closes. Now, this is in stark contrast to the other sale Goldman is pursuing, the divestment of its consumer lender, Green Sky, at a steep discount, just over a year after it completed that takeover. Bloomberg has learned that the sale is now in the home stretch, with groups including Apollo and Sixth Street working on what's poised to be their best offer. As for Creative Planning, the money management firm buying the investment advisory unit, it is run by Peter Mallouk, who's written several investment self-help books. His firm already has a custody deal with Goldman, and he said that expanding that partnership is a great strategic fit. Sue Keenan, Bloomberg, New York.
Coming up, we'll focus in on commodity markets. Chevron workers at its Australian natural gas export plants are threatening to go on strike. More on what that could mean for global energy markets next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
This is Markets Today. We are 23 minutes into the European trading day, the second of the week for most in Europe, the first in the week for the London market. And so the London market is playing catch up by 1.4% or so on the FTSE 100. Slightly more modest gains elsewhere, but still gains across European stocks for another day. Now, European gas has retraced some of yesterday's gains, which came as workers at Chevron's Australian LNG plants threatened to strike next week. The possibility of strikes has roiled global gas markets since early August, when unions first voted for potential labour action. Joining us now is our senior energy reporter, Stephen Stapczynski, in Singapore. And this is such a global market, Stephen. You're in Singapore. This strike action is in Australia, potentially, and the market impact could be here in Europe. What's the latest on the strike action that we understand?
So right now we're expecting strikes to start from September 7th. That's next week. If there is no deal between Chevron and the workers, there's no indication right now when they're going to meet again and if they're going to make a deal. Now, Woodside, another LNG producer in Australia, was able to make a deal with the unions last week, and they avoided strikes. Chevron might be able to do the same thing, but at the moment, it looks like strikes will likely start from September 7th. And what we're hearing is it will be in that first week about as much as 11 hours of work stoppages, so like half the day they're not going to be working at these facilities, and then they're going to ramp that up week on week over the rest of September until likely production is affected. Now, LNG. Australia is a major LNG exporter. They're one of the biggest in the world. These two facilities operated by Chevron provided about 7% of global LNG supply last year. Europe doesn't import LNG from Australia, but as you said, it's a global market. It's going to cut. If there is an outage in Australia, that means Asia can't get the LNG. And if Asia can't get the LNG, they're going to try to buy spare shipments from the U.S. and other places. That puts them in direct competition with Europe. And the fear here is that if there's an outage in Australia, it will boost global competition for LNG and increase prices in Europe and in Asia, as well as South America and other places that import LNG. So indeed, it is global, and the market is very tight because after the war in Ukraine began last year, Russia cut off most pipeline gas supply to Europe. Europe depends a lot more on LNG, so the LNG market is key here, especially going into winter when gas demand peaks.
Yes, and let me ask you about that demand story then, Stephen, because I suppose one thing that would weigh on prices is the weakness that we're seeing in the Chinese economy, the weakness that we're seeing in the European economies right now. Is that something that, at least in terms of the gas markets, we're thankful for, because it means that we are not seeing such a frenzy of bidding higher for LNG shipments?
Certainly. We're in a finely balanced global gas market, and that's largely thanks to what you would call demand destruction, basically industries consuming less, shutting factories, Chinese demand not rebounding as much as folks expected. Javier Blas from Bloomberg Opinions wrote a great column today about how that weaker demand has essentially solved the problem of the gas crisis, right? The higher prices reduced consumption, but at what cost, right? That industrial output is much lower now. And another thing is, you can't really crank down demand, especially from factories, industries, more than what they've already done now. So that looks at supply. If supply were to suddenly leave the market, if you're not getting the Australian LNG, there are very few levers you can pull to balance things, and that's what's spooking the market. Even though strikes haven't started yet in Australia, the fear has boosted prices significantly.
Stephen, thanks so much. Bloomberg senior energy reporter Stephen Stapczynski joining us there on the global gas markets from Singapore. Now, coming up, Germany's consumer confidence comes in worse than expected as sentiment around Europe's largest economy continues to deteriorate. Analysis next. This is Bloomberg.
we're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Markets Today. 30 minutes into your European trading day. Here are your top stories. European stocks follow Wall Street higher, with investors focused on upcoming economic data. The auctions of 2- and 5-year Treasury notes draw the highest yields since before the 2008 financial crisis. China stocks join the bounce, but the gloom continues as economists trim their growth expectations. Investors weigh the country's struggling recovery against Beijing's efforts to boost sentiment without big bazooka stimulus. Plus, Bloomberg learns who is the buyer of Goldman Sachs' mass affluent investment advisory business as the bank refocuses its attention on the ultra-wealthy. Good morning, everybody. Let's check in then half an hour into the trading day on these European markets. The Stoxx 600 up by 0.8%. The DAX gains, the FTSE 100 gains more because, of course, it was closed yesterday. So welcome back to the markets if you were out yesterday. And we see the FTSE 100 up by 1.7%. In terms of the sector breakdown, we've got some strong performance coming through on real estate stocks, basic resources, media also doing pretty well this morning. Joe Easton was talking us through some of the moves in real estate a moment ago, which were interesting. And basic resources perhaps getting another boost from China and catching up maybe on some of the boost that China provided to European stocks yesterday. And speaking of Joe Easton, he joins us now with a look at some of the movers in today's session. Joe.
So NN Group over in Amsterdam, the best performing stock still after around 15 minutes of trading, or a little bit longer than that, over in Amsterdam, up 10% now. That will be the best gain for that stock in a few years. It's a $10 billion insurer in terms of their market cap, and the life business is doing really well. We're already seeing one analyst upgrading its rating on that, helping to push that one higher. Now, the rest of the stocks pretty UK focused given the market reopening. Again, watch the Switzerland, which I touched on briefly. That one rebounding a 20% slump on Friday, caught everyone by surprise with Rolex moving into the retail space, so seeing that one bouncing a bit. And then Bunzl is the UK distribution company. They've reported some strong earnings this morning. They also do packaged goods and that kind of thing sold into retailers, so a strong one there. And Britvic upgraded over at Barclays, the first time they've ever had a buy rating on that stock, and pushing the maker of drinks higher this morning. In terms of the decliners, one that stuck out to me was Carrefour. I'm not really 100% sure why this one's down. I think there's something pressuring that stock. I've asked some trader contacts to have a look at that one, so potentially see what's going on there. That's underperforming the UK grocers, which are pretty much moving higher given that data that we saw earlier. Then we see Grifols. Now this one downgraded at Morgan Stanley. This is a Spanish pharmaceutical and biotech company that is seeing a decline in some of their margins according to the US bank. So that one falling today. Adyen, the continued decline for the Dutch fintech company, down around 50% since that massive profit warning just over a week ago, weighing on that one. And then finally, the gym group, they continue to see declines in some of their opening rates, so some of their new gyms not opening as fast as expected, according to analysts. We've got our eye on that one. There might be some other news pushing that one, so I'll keep an eye on gym group today.
Joe, thanks very much. Joe Easton from our equities team. Yeah, quite a notable drop in the Carrefour share price, and it's not like it moved all that much in yesterday's session, so more digging there, maybe. Now, Germany's economic outlook continues to look gloomy. Consumer confidence data out this morning came in worse than expected, following a hit in business confidence, a hit to business confidence last week. Our Europe correspondent, Maria Tadeo, joins us now from Brussels. Maria, we had that worse than expected print, and we get CPI flash estimates tomorrow. Is Germany going to be the sick man of Europe for longer? I know that we've already had some pushback against use of that phrase from the Bundesbank president.
Yes, Anna, and look, they don't like it. The government doesn't like it. They push back. A lot of that narrative of the sick man has been playing out for months. Also remember that front page of The Economist that really ruffled feathers in Berlin. We also had, as you say, the central bank and Mr. Nagel pushing back against the idea that Germany is the sick man of Europe at this point. Having said that, when you look at the data, obviously there are concerning issues about this economy. You talked about the consumer confidence indicator today. It would decline, or would seem to be declining more than expected. It has been declining now for months. A lot of that feeding into the anxieties and the fears around the German manufacturing, but not just that, because we also had the PMIs last week, which are obviously bad on the bigger picture. The three indicators were pointing to a contraction, but also interestingly, this idea that yes, manufacturing has been a problem ever since the energy crisis kicked in, but also concerns about the consumer and the services of the economy that would not be strong enough to balance out the declines in manufacturing. So overall, clearly, they do not like this narrative. But when you look at the data, it is hard to pinpoint a single indicator that would say there are reasons to be optimistic about Germany for the time being. Obviously, it's not nice to be referred to as a sick man of Europe, but again, the indicators do paint still a concerning picture when it comes to the biggest economy in Europe.
Okay, and we're due to get some data out on the inflation side, on the pricing side, which the ECB is obviously focused on. I saw some analysis this morning that suggested it'll be core that's once again in focus, and that will keep a September rate hike on the table. That's kind of what markets are seeing at the moment. What are you expecting?
Yes, Anna, and again, this is a crucial print before that ECB decision that will happen in a few weeks from now. We have German numbers that will come out tomorrow, but also the big euro area was focused on the core as the European Central Bank targets headline inflation, sure, that 2%, but they want to see real indicators that there are pressures pointing down to inflation on the core that will be sustainable over time. So this is not just pegged to energy going up or down. Again, that will be a significant number for the European Central Bank to some extent, because it is the final CPI print before that decision. But we should also stress, Anna, a lot of the data obviously features or would focus on the forward-looking indicators too. The ECB will put out new projections too. That will carry almost equal weight compared to the numbers that we may get for August. And again, those projections could build the case for the European Central Bank to either hold or hike. Because Anna, at this point, there is still a big debate, nonetheless, in the market as to which way it will go. And of course, when you listen to the head of the ECB, Christine Lagarde, she did not point to either way in that Jackson Hole speech. So again, that debate, the pulse of the market, very much in that, will it be a hold or a hike?
Yeah, absolutely. Christine Lagarde, ECB president, talking much more about the bigger picture considerations of monetary policy rather than the questions around September. Bloomberg's Maria Tadeo, thank you very much, setting us up for that data due out this week from Brussels. Now, Telecom Italia is gaining this morning. That's after Italy approved a decree which empowers it to take a stake in its network business. The move is part of an effort by Prime Minister Giorgia Meloni's increasingly activist government to assert more control over strategic assets. Let's speak now to Bloomberg's Milan Bureau Chief Tommaso Ebhardt, who can give us analysis. Tommaso, more on the politics in a moment, but just on what's changed, what's new information here. Give us some more detail on what the government is doing.
Sì, buongiorno da Milano. It's quite interesting. Giorgia Meloni is very active. Yesterday night she held the first cabinet meeting after the summer break, and in the cabinet meeting she approved the decree to give Italy the chance to buy up to 20% stake in the Telecom Italia's network, which is being sold by the former monopolist, which has over 30 billion of gross debt. Very interesting, because this could be an important move in talks which is going on for months between Telecom Italia and potential bidder. Now the bid is managed by KKR, so KKR is going to buy the network, but the fact that the Italian government is going directly with the American fund means that Italy wants really to sell the asset. Obviously, it's not a done deal. Why is not a done deal? Because Vivendi, Telecom Italia biggest investors, has said that the valuation is still too low. So we'll see if Vivendi now will talk directly with the Italian government.
Okay, so that's some of the corporate news. Tommaso, set this in the broader government and political context for us. This just the latest step, I suppose, in what's been an increasingly activist leadership from Giorgia Meloni.
Absolutely. We have seen in the last few weeks some very bold move by Meloni, which also worried a bit investors. First of all, you all remember at the beginning of August, Meloni announced a surprise windfall tax on the bank's profit. Then she's also working on a new measure for the non-performing loans market, which could jeopardize the market. So investors are really worried. Now we see her activism on corporates, with Italy directly investing in Telecom Italia. Is looking like that after a few months when Meloni took the job without making any bold decision, now she's really want to show that the state capitalism in Italy is alive.
Okay, thanks for the update, Tommaso. Bloomberg's Milan bureau chief, Tommaso Ebhardt, with the details of that corporate story and its broader impact. Now, coming up, drivers beware, some of them anyway. London's ultra-low emission zone expands today. We'll discuss the political implications of the plan and just how far these changes go. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Markets Today. Welcome back to the programme. 42 minutes into our European trading day. It is, of course, the first trading day for London, so London plays catch-up, up by 1.5% on the FTSE 100. Other markets also making gains, though, as we gain, waiting for important data out this week on prices in the Eurozone and the US and on the jobs market. Now, let's talk about something that's changing here in London. London's enlarged ultra-low emission zone, or ULEZ, comes into force today. High-polluting vehicles pay £12.50 per day to enter the expanded zone that covers a lot of London. That is on top of the congestion charge for inner London. Bloomberg's Olivia Rudgard joins us now. And Olivia, this isn't new. It now is going to cover a bigger area. It isn't going to apply to every driver at all, because most drivers are exempt from this because of the type of vehicles they drive. But explain to us how this became such a big political issue in the UK as a result of a recent by-election.
Yeah, so I think it really became a wedge issue in as you say, the by-election, which was in Uxbridge in West London, which is an outer London borough where there are a lot of people who do drive, and there was a lot of anxiety about it, and it became a really big campaigning issue. Labour, Sadiq Khan, the mayor of London, is a Labour mayor. His party lost, not him, but that the party lost that election quite narrowly. But the lesson that was taken from that was that this is going to be something that you could campaign on, and I think the Conservatives have really taken that and run with it, and it's, as a result, some environmental policies have become kind of big election issues. Yeah,
so that's the politics, and more on that in a moment. But just to clarify, who is affected here, you have to have a petrol or, a gasoline car, as it's known internationally, that's older than 2005, 2006 to fall foul of this rule and to have to pay this £12.50 charge. So how many people are actually going to be affected by this?
Yeah, so it's actually quite a small proportion. It kind of depends on what metric you use, but for drivers of cars, it's roughly around sort of 10 to 15% of cars. Yeah. So it's not everyone, yeah.
And on the van side, it's a bit more punitive with diesel, isn't it?
Yeah, the vans are much more likely to be diesel, so about around 90% of vans on the road are actually diesel vans, so it's a much higher proportion than cars. So van drivers, the mayor's office says it's around half, but, it depends on what metric, so it's a little bit more, but it's definitely not everyone.
Yes. Just in the wake of that Uxbridge by-election then, we kind of saw this coming. Everybody was sort of suddenly talking about, well, what is this going to do to the Conservative Party's commitments around the green agenda, which many have argued, and I've spoken to environmentalists who've argued, have declined since even under Boris Johnson. So where does this leave the Conservatives on green matters?
Yeah, so I think, net zero, the UK has a legal commitment to net zero. It's not the same thing as ULEZ, but I think what's been identified potentially politically is that this is something that can really be campaigned upon nationally. Whether that's a successful strategy or not, I think is, open for debate. But there are a lot of things, there's a lot of rhetoric now coming out of the Conservative Party around some of the policies that are sort of coming down the track around home heating, oil and gas, because I think that they've identified this as something that maybe there's a bit of anxiety about, where there are upfront costs for people around environmental policy. There are benefits down the road, but I think it's those upfront costs that they're sort of trying to make sure people, don't feel like they're having that cost put on them straight away.
So yes, you're right. This ULEZ policy very much about air quality, isn't it? About pollution rather than about greenhouse gases and net zero. But the two are being interestingly conflated. Thanks very much, Olivia, for joining us. Bloomberg's Olivia Rudgard with the latest on that story. Let's get some of our other top stories on the Bloomberg terminal this morning. Unprofitable Vietnamese EV maker VinFast is now worth more than the likes of Goldman Sachs and Boeing. That's after surging since its trading debut earlier this month. The company's market cap now stands at around $190 billion, meaning it's bigger than half of the firms on the Dow Jones Industrial Average. Options on the stock also began trading yesterday, giving traders the opportunity to make leveraged bets on the rally. Former US President Donald Trump will head to trial on March the 4th next year on federal charges of trying to overturn the 2020 election result. That's the day before the Super Tuesday primaries that are key to his bid to regain the White House. Trump wanted to delay the trial until April 2026, long after voters decide whether he will get a second term. But the judge says the public has a right to a prompt resolution. And Lone Pine Capital clients withdrew some $3 billion from its funds in the 12 months through June. According to Bloomberg calculations, clients pulled more than $1 billion from its Cyprus hedge fund. Redemptions from its Cascade fund totaled about $1.7 billion. Most redemptions happened in the second half of 2022, a year both funds had significant losses. Coming up, post-Jackson Hole, we will look at what could be moving markets this week, including some of the data out from the United States, payrolls data due. We will also get the PCE inflation print from the United States. This is Bloomberg.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
The yuan is going down. Well, down against the dollar, at least. That's the conclusion of professional and retail investors in the latest Bloomberg survey. They say that we'll get to 7.6 yuan per dollar before the end of the year. That would be a level not seen since the offshore yuan began trading more than a decade ago. Already, growing problems in China's vast property market are deepening cracks in its economy and pushing down the currency. Those worries have kept the yuan weaker than 7.2 to the U.S. dollar since early August. It's even flirted with a post-pandemic low, prompting government intervention. But easier monetary policy isn't helping, nor are signals from the Federal Reserve that interest rates could remain higher for longer, policy that's likely to keep the dollar strong. Elsewhere, falling asset prices aren't enough to lure in bargain hunters, with only around 1 in 5 investors looking to increase their China exposure over the next 12 months. There's little consensus about exactly what the impact of a significant sell-off in Chinese shares would be. About a third of professional investors don't see any significant contagion risks to equity markets, but roughly equal proportions believe that an additional 10 or 20% decline could set off a global stock sell-off. The message is clear from surveyed participants. Don't bank on hopes for sweeping government aid. Though more than half say the Chinese government will offer some sort of moderate response targeted at specific industries, only about 1 in 10 think authorities will fire any bazooka-like stimulus to avert a crisis, and the remaining third say it will be too little, too late.
That was Bloomberg's Simone Foxman with the latest results of the Markets Live Pulse survey, with some pretty negative takes on what's going to happen in China. Let's talk about what's happening in these markets this week. Eddie van der Veld joins us from our Markets Live team. And Eddie, I mean, does it make sense to you, the strength we're seeing in stocks, the risk appetite we're seeing for stocks? We saw, yes, we have yields a little lower today, but broadly speaking, the trend in August has been for yields to go higher. The Chinese economy still struggles. Where do you think this positivity is coming from?
Yeah, absolutely. Look, so we had Jackson Hole at the end of last week, and that it was kind of not really much new. It kind of feels like, you know, you're watching Rocky VII at this stage. You know how the script is going to play out at Jackson Hole, right? And investors know that they're not going to get very much new from there. So I don't think much of what we're seeing in the markets right now is about that. I think what we are seeing, in fact, is much more about what happened in China. Now, we just saw that investors are not expecting a big bazooka, but what we did see is intervention directly in the stock market, and that's a real pivot in China, right? Because if they move away from just supporting the property market and they move towards supporting the stock market, that will have real implications beyond its own local market, because it boosts speculators. Speculators aren't only going to focus on China, they're going to focus on other markets as well. And I think that's helping support UK and European stocks.
Okay, and then looking at the Waco function on the Bloomberg terminal, Eddie, I can see we get some data out from the US. It isn't the top tier stuff today, but we get some interesting insights around housing and also the job openings picture. And later in the week, jobs will certainly be in focus. What will you be watching for?
Yeah, and that jobs number, I think, is actually more important than people give it credit for, because jobs openings at the moment, it has been really high above expectations. It's been trending lower, but that's one center that has been driving wage inflation, because if there's more jobs out there than there are workers filling it, then, there's only one way for wages to go. That feeds directly through into inflation. So I think that jobs number is really important. And then, of course, as we get into the inflation numbers for Europe tomorrow. So I think it's a really interesting day, particularly as policymakers tell us they are more data dependent. These data sets become more important in just setting the tone for markets.
Yeah, and with that in mind, Eddie, I was looking at some analysis by Bloomberg Economics on the Eurozone side that said it's going to be the strength of the core reading around inflation in the Eurozone that, in their view, is going to keep a hike in September on the table. That does seem to be what the market is expecting right now. What will you watch for?
Yeah, the Eurozone obviously has a much more difficult game to play than the Fed and other central banks, because, in Europe, growth is already quite weak if we look at those PMI numbers and so on that they've had. Now, I think that, of course, they will want to bring inflation down sharply. Base effects are starting to be priced out. Some of those high energy costs of last year are starting to, the impact is starting to wane. So I think inflation could still be significant and strong. And of course, the core number, very important.
Yeah, so we'll watch that core number when it comes through. Eddie, thanks very much. Eddie van der Veld from our Markets Live team. Remember, you can get up-to-date analysis and insight from Eddie, from Mark Cudmore, the rest of the Markets Live team. MLIV Go is the function to use on the Bloomberg terminal. So we're seeing, as I said, the second trading day of the week for many European markets, the first trading day of the week for London. And so no surprise that topping the GMM equities column is the FTSE 100, playing catch-up with the rest of European equity markets. We see the Italian market is trading higher. Interesting that some other markets around Europe, though, losing their positivity. The CAC 40 was a big gainer yesterday. Today, we see it under a little more pressure. So it gained yesterday. Today, we were hearing from one of our colleagues, Joe Easton, earlier about a little bit of a move downwards in Carrefour. That's pretty heavily weighted there. But actually, it's the luxury side that also is taking points off the CAC 40. So LVMH added yesterday, subtracting a little today as it moves down. That heavyweight luxury player down by 0.3%. So that weighs on that particular market. More broadly, then across stocks, we are pretty positive still, although US futures just dipping into negative territory. So maybe that handover of positivity from Asia has kind of run out of steam. E-minis are flat. NASDAQ futures pretty flat to negative right now as well. We see natural gas prices coming down a touch on the European benchmark this morning. That's maybe a silver lining, but very focused on the Australian strike story there. That is it for markets today. More market analysis next. This is Bloomberg.
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. And market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. China's outlook shows no sign of improvement as economists trim their growth expectations while traders await a raft of data over the next few days. Now, the UK's food inflation actually cools to its lowest level in almost a year, relieving some of the pressure on the Bank of England to keep raising rates. Plus, Bloomberg also learns who the buyer is for Goldman Sachs' investment advisory business as the bank refocuses its attention on the ultra-wealthy. So first thing is first, let's check on what traders are looking at. Now, this is the European markets map. I would suggest after the bank holiday, certainly in the UK yesterday, that we're seeing maybe, if not subdued action, maybe not the excitement of the last couple of weeks, but look out for any move when we have quite a lot of data coming out later this week. We not only have PMIs out of China, we have CPI in Europe, and of course, the big one is U.S. jobs. So for the moment, we're seeing the FTSE gaining some 1.2%, the DAX 0.1% higher, and then you can see, for example, the CAC 40 pretty much unchanged. Now, the focus is, of course, still on Jackson Hole, on what we heard from Jay Powell, and therefore we look at what the U.S. 2-year is telling us, hawkishness more or less holding following this Jackson Hole speech where we heard from Jay Powell, the Federal Reserve Chairman, really saying in a highly anticipated speech that the U.S. Central Bank is prepared to raise interest rates further if needed, and that borrowing costs will likely remain elevated. You can see that 2-year currently at 4.9896. We watch for 5. Yen, of course, this is on the back of what we heard from Jackson Hole, and this is an interesting Goldman Sachs call, basically saying that it's going to hit yen. The country with a very dovish central bank will see further currency weakness, with possibly seeing yen at 155. That would make it the weakest since the early 1990s. You can see at the moment 146.45. And then the third story that we really want to focus in on is what's happening in China. We have full analysis from our team on the ground and here in London. The Hang Seng having a couple of really quite strange days. So we saw a sell-off on Friday. We also saw a bit of a sell-off yesterday, and today we're rebounding a little bit strong. Difficult to call bottom as we see and expect, actually, traders are expecting PBOC and other policymakers to try and support the Chinese economies in other ways. But if you look at all the major banks, a lot of them have actually taken out their position on Chinese stocks. Now, China's economic outlook is showing no signs of improvement. A Bloomberg survey shows that economists now see China's GDP growing 5.1% this year compared to 5.2% previously, weighed by the property sector and slowing exports. Now, speaking of the property sector, Country Garden seeking a 40 calendar day extension for its maturing yuan bonds. Now, the shares gained off the back of that news. Well, more on China's economic troubles shortly with JP Morgan's Karen Ward. But first, let's also go to Bloomberg China executive editor John Liu in Beijing for the latest on the geopolitical front. So, John, great to speak to you. The U.S. Commerce Secretary Gina Raimondo is in Beijing this week. Who's she met with, and what exactly has been discussed?
Well, this afternoon, she's just met with Chinese Premier Li Qiang. He's the second highest ranking official here in Beijing. We don't know the specifics of what happened behind closed doors, but we do know that Secretary Raimondo here has been trying to pitch the story that decoupling and de-risking are two separate things. That means there's a lot of trade that China and the U.S. do that has nothing to do with national security, and that should continue unaffected. but things like chips, other technologies that do affect national security, Washington will take things to protect itself in those circumstances.
So, John, China has also confirmed that UK Foreign Secretary James Cleverly is also visiting tomorrow. What can we expect between the UK and China?
So we understand that Secretary Cleverly will want to discuss Ukraine and Russia and China's role in that situation. What will China want to discuss? We did just have recently a newspaper here in China, the Global Times, a relatively nationalistic-leaning paper, calling for the British Museum to return all Chinese artifacts that were taken illegally. And so that could be an issue that is raised by the Chinese side when Mr. Cleverly is here in Beijing.
John, overall, I know that there's been a lot of concern about the strength of the Chinese economy. Do you feel it on the ground, or is it front-page news?
It is definitely the thing that people are talking about. The mood here is very pessimistic, and that I think is primarily because of property prices. Home prices have continued to fall for a number of months, and with about 80% of household wealth tied up in people's homes, people, even if they're not making less, they're feeling a lot poorer as a result.
Thank you so much, Bloomberg Greater China Executive Editor John Liu there. Now joining us now to talk about the markets, the impact, of course, that the China slowdown or concerns about China has on the rest of the world's Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Karen, always great to speak to you, so thank you so much for coming on. When you look at some of the concerns on China, they seem to be getting worse instead of better. What does it mean for the impact that China has on Europe, for example?
Well, I think one of the reasons that Europe is looking particularly weak is because it is more dependent on China than the US, for example. So the question really is, what is China going to do to stabilize activity and try and boost growth? And I think this is the tricky thing at the policy-making level, because traditionally that stimulus has always been build stuff, infrastructure, build new towns, build new infrastructure. But obviously they've had 2 decades of that type of stimulus. As John mentioned before, there is an overhang of property. So the question now is what type of stimulus? And we're seeing them over the past week, lots of tinkering around the edges, very much moving away from a build stuff model of stimulus towards an incentivize, more like what we do in the West, lower interest rates, try and incentivize people to feel better and to spend. But we know here in the West that that's less quick and it's less predictable. So I think how China plays out in the second half of the year is one of the big unknowns.
Karen, let's also listen to what Gina Raimondo was saying about this relationship between the US and China. Here she is.
We agreed to establish a new commercial issues working group, a formal working group, which will involve US and Chinese government officials, and very importantly, US and Chinese commercial private sector representatives, as we seek solutions on trade and investment issues and to advance US commercial interests in China.
I mean, it's difficult to see also in an election year in the US how the relationship between the US and China pans out and what that means for the rest of the world.
Yeah, absolutely. I mean, it's been something as investors we've had to contend with since Trump in 2017. And what we've learned, I think, through that period is there might be political ambitions that lead to things like tariffs and trade wars, but the economic realities of how far you can take these moves are limited just by how interconnected the economies are. I mean, we saw with the trade wars and the tariffs in 2017 and 2018, yes, it was damaging the Chinese economy, but it looked like it was damaging the US economy just as much. So I think trying to find that constructive dialogue approach through. But as you say, it's an election year, so I think we certainly have to be aware that there'll be some saber rattling along the way.
So what does that mean, Karen, for, again, things that you like at the moment? Is it equities versus, fixed income, or are we at the end of the cycle?
I certainly think we are still in an end cycle playbook. I mean, less about the relationship with China, but I think what happened in the first half of the year in the markets was a little too good to be true. Markets sort of bought into this idea that we could have resilient growth across the West, and yet all those inflationary pressures would disappear on their own, and the central banks could move from tightening to easing. That hasn't historically been the way things have played out, and I don't expect it to be this time around. Sadly, I think it is going to require that weakness. The likelihood of a recession, I think, is still high, because that's what's going to get rid of inflation.
What did you make of Jackson Hole? So it wasn't maybe the market-moving event that we've had in the past, but Jay Powell still was very, very clear in that rates could be higher for much longer.
Yeah, absolutely. I mean, the message from all of them in different ways was, we're not confident the job is done. We're not confident we are sustainably heading back towards 2%. Both sides very much worried about the inflationary pressures that are still emanating from the labour market, record low unemployment, and therefore wage growth staying high, and as Lagarde called it, that sort of tit-for-tat inflation. And I think that's exactly right. Until it's really clear that activity is loosening the labour market, that wage pressures are easing, we can't be convinced that we're back to 2. So that does leave us in a higher for longer world, which is really important for investors. And I still think that's where the investment community hasn't quite adjusted to this new world that we're in.
So, Karen, if you think that actually markets were a little bit too optimistic in the first half of the year, are we going to see a correction in the second half, given also all these inflationary pressures, or the fact maybe that traders have not caught on that we could stay at these elevated interest rates for a lot longer than expected?
Yeah, absolutely. I think as we start to see, we saw with the PMIs, that was oh gosh, maybe the economic resilience isn't quite as we were hoping for, and it caused that reassessment of the realities. I do think we're going to see some more of that volatility. I don't think we're going to touch the lows that we saw last October. I think we are in a better place than where we were then, but I certainly think that more volatility, so staying very quality focused at these levels, starting to extend duration, that's the right thing to be doing right now.
I mean, the key to volatility is being able to call bottom. I mean, is that impossible to know when to enter the market?
Generally, I would say we should always be humble about our ability to do that. But I think right now, with how the world has changed, with some of the things we're just understanding about the energy markets right now, about the labor markets right now, there are so many structural shifts that are underway that I think that degree of humility, and certainly therefore about very outsized positions in either direction, that's not the thing to be doing right now. We've got a lot to learn.
Are markets not honed in enough on earnings fundamentals?
I'm not sure that's definitely the case. I mean, if you look at excluding, for example, the big tech companies, we can certainly see that valuations aren't obviously terribly excessive, maybe a little so, given I do think we're going to see more earnings weakness than perhaps what's in analyst forecasts right now. I mean, one of the big questions, of course, out there is whether AI is this new economic miracle, or whether it's sort of the new economy that we heard Greenspan talking about in the late 90s all over again. But obviously for some stocks, I think certainly the growthy segments of the market, being really comfortable with your fundamentals, because as I said, I don't think zero interest rates, that zero discount rate, that's not going to come riding to the rescue as we look forward.
Karen, thank you so much. Karen Ward, of course, stays with us. We'll talk about the UK next as food inflation cools to its lowest level in almost a year. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world? And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
From the world of politics politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. All eyes are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labor market is still tight.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, Friday on Bloomberg Television and Radio.
The conversations that matter, the insights you need. This is a pulse. I'm Francine Lacqua here in London. Now, the slowest increase in grocery bills in almost a year drove down inflation. British shops in August, relieving some of the pressures on the Bank of England to keep raising interest rates. Now, still with us, Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Karen, thank you so much for sticking around. When you look at the UK, for a long time we said, look, they have it worse than a lot of other countries. It's a small open economy with a tight labor market. Is this getting easier as the drop in inflation could actually come quicker?
Yeah, I mean, I think a few months ago, the UK really looked like the basket case, didn't it? The US inflation rate was moderating quickly. It was starting to happen in Europe as well, and just wasn't coming down in the UK. Now, some of that is lagged effects, which are going to come through. So I think the UK, on a relative basis, is going to look better. Energy is still contributing a lot. That's going to drop out. Food, as we heard this morning, that should start to drop out too. So headline's going to look better. Now, where the concerns still are there across the West, but probably more so here in the UK, are those deep pressures that we just talked about in the labour market, because our labour market is tight and our workers are asking for more pay. Understandably, they've had a huge shock to the cost of living. But that wage print that we just had recently shows, 7.8% wage growth is not consistent with a 2% unemployment target, 2% inflation target. So that's the challenge for the Bank of England now, is it has to create that weakness. We do need to see the labour market weaken. We need to see wage growth coming down for them to really feel comfortable that core is going to follow headline. So I don't think the Bank of England is as close to a pause as perhaps certainly the Fed and maybe the ECB are.
So what happens, I mean, is crunch time for inflation in the UK, but other places also when it touches 4%? Is there a worry that actually gets stuck at 4%? Like, what do the models tell you?
Somewhere between 4 and 3. I think that's right. I mean, we've seen as the US is sort of getting down towards 3, it's that 3 to 2, which is looking stickier. And of course, all the while you're stickier a little higher, you're at risk of something like an energy shock giving you another lift in headline inflation. I mean, that's one of the concerns I have about H2, keeping me a little cautious, is that oil prices, which are stubborn at 85, still a lot of uncertainty in the energy markets, how Europe goes through the winter. If we were to see headline inflation start accelerating again, when the labour markets are still tight and core inflation is still already high, we're going to be right back in those inflation, gosh, what are peak rates concerns? We've just got to be a little careful about that narrative.
Where do you think there are peak rates? And are we going to see cuts into next year, or will we have to wait for 2025?
I think we probably are near peak in the US. I think the Fed, we could get 25 basis points out of them at the next meeting, possibly also the ECB. I think we're going to probably get 2 more out of the Bank of England. I don't think as time passes, it's going to be quick enough for the labour market to weaken, for them to get the signals that they can pause. As to the cuts, I mean, this is where it's very tricky. Economies tend to be quite stubborn. I find myself in these days very much reminding myself of the 2000 cycle, where there was huge resilience as rates were going up, and it looked like the economies could cope with higher interest rates. But then, of course, when that crunch happened, it all unraveled quite quickly. I don't think it's going to be a 2008 style unraveling. The banking sector is in much better shape. We've already seen that this year. But certainly how things unravel, how sticky inflation is, But in direct answer to your question, I think it's going to be later. I don't think inflation is going to allow the central banks to ride to the rescue quickly at the first signs of growth weakening.
So, Karen, in terms of how you play the markets for the UK, does the UK look more attractive than it did even a quarter, or is it same?
No, I think, as I say, a few months ago, the UK was really seen as this outlier, this inflation basket case. Things were absolutely out of control. Maybe the Bank of England was going to have to see 6.5%. We were going to need this awful deep recession. I don't think that is the correct narrative. So I do think that, rates expectations are still pretty high, probably maybe a little high, but not too much. So I think re-entry into certainly the bond markets in the UK seems more sensible from here. I think that the stock market has been incredibly cheap on a relative basis for quite some time. I'm not sure what's going to bring sentiment back. I think it will be when we're well into the next cycle, we'll start to see some of that sentiment improve.
How tricky is all of this for the Bank of Japan?
Well,
I mean,
yeah, absolutely. I mean, we're going to see a convergence. That I'm confident of. Yeah. Now, the question is it going to be that everyone converges back down to the Bank of Japan? Yeah. Or is the Bank of Japan going to converge up to higher rates that we see elsewhere? I would say we're more likely to see the latter. I think the Bank of Japan has been saying, no, this is temporary, this is transitory, it's all going to go away. I've heard that narrative before. It didn't go away, and I do think, therefore, this adjustment that we're seeing to the policy, we're on a slow route of that continuing, and we'll continue to see yields push higher, and that's going to take the yen with it.
Karen, as always, thank you so much for joining us. Karen Ward, Chief Market Strategist for EMEA at JP Morgan Asset Management. Now, coming up, Goldman Sachs strikes a deal to sell an investment advisory business as it renews its focus on ultra-wealthy clients. Details ahead, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power.
This is Bloomberg.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, Bloomberg has learned that Goldman Sachs' sale of its consumer lending unit Green Sky is entering the final stretch. And it comes as Goldman also plans to sell its $29 billion investment advisory business to Creative Planning. Bloomberg's Sue Keenan has a story.
This is a move that underscores Goldman Sachs is refocusing on what it does best, managing the money of the ultra-rich. The sale of the investment advisory unit is related to failed forays into consumer banking and efforts to market its services to the mass affluent class, the mere millionaires next door. Goldman has now agreed to sell the investment advisory business that grew out of its purchase of United Capital just 4 years ago. That unit has $29 billion, and Goldman not revealing the price, but says it expects to recognize a gain when the deal closes. Now, this is in stark contrast to the other sale Goldman is pursuing, the divestment of its consumer lender, Green Sky, at a steep discount, just over a year after it completed that takeover. Bloomberg has learned that the sale is now in the home stretch, with groups including Apollo and 6th Street working on what's poised to be their best offer. As for Creative Planning, the money management firm buying the investment advisory unit, it is run by Peter Mallouk, who's written several investment self-help books. His firm already has a custody deal with Goldman, and he said that expanding that partnership is a great strategic fit. Sue Keenan, Bloomberg, New York.
Well, the Federal Reserve's head of bank supervision, San Francisco, will also retire on October 31st. Azar Abazi, along with San Francisco Fed President Mary Daly, came under scrutiny in March following the sudden collapse of Silicon Valley Bank and other lenders. Abazi will be temporarily replaced by Neil Willardson, a former Minneapolis Fed official. Now, coming up, German consumer confidence drops more than expected this morning ahead of inflation prints tomorrow as Germany, the sick man of Europe. We'll have plenty more on that next. And this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg. your global business authority.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Now, China's outlook shows no sign of improvement as economists trim their growth expectations while traders await a raft of data over the next few days. The UK's food inflation cools to its lowest level in almost a year, relieving some of the pressure on the Bank of England to keep raising rates. Plus, Bloomberg learns who the buyer is for Goldman Sachs' investment advisory business as the bank refocuses its attention on the ultra-wealthy. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Germany's GfK Consumer Confidence Index fell more than economists expected this morning. The September reading came in at minus 25.5 versus negative 24.5. Well, let's get more from our Bloomberg Europe correspondent, Maria Tadeo. Maria, good morning. So German consumer confidence or sentiment coming in worse than expected. We also get CPI flash, CPI prints tomorrow. Is Germany going to be the sick man of Europe for longer?
Yes, Francine, and that is a question at this point. And we know that they do not like this narrative. The German government has pushed back against the idea of Germany being the sick man of Europe. Last week also we spoke with the head of the central bank, Mr. Nagel, who also said that a lot of this was exaggerated. The problem is, Francine, when you look at the data, it does paint a bleak picture for the biggest economy in Europe. You talked about the consumer confidence that came in. It fell more than expected for September. It has been in decline now for months too. When you look at the PMIs that we got last week, they were all bad, and not just the overall number, but really the three indices inside not only point to a contraction, but they were also pointing to ongoing weakness in the manufacturing and almost ruled out the idea that the consumer and services could be strong enough or gain enough momentum to balance out the weakness that we see play out in the industry. Now, that is for the consumer side of things, the confidence side of things. Tomorrow, we're expecting CPI coming out from Germany, and then, of course, the big number on Thursday, that is CPI for the euro area. This will be the final print, CPI print, before the ECB meets, with that hold or hike now openly on the table. Now, we are expecting both the headline number and the core number to cool down, but again, a lot of this will possibly make a difference to the European Central Bank when it comes to their assessment, but also it'll be interesting to see how that feeds and matches the new forecast that will come up by the ECB in September, when that decision is expected to take place.
And of course, as even if we could see interest rates peaking in Europe, the pain for consumer companies and governments that borrow trillions of euros may not be over. Then, Maria, I know you and I are both obsessed with what's happening in Spain and in the football world. What's the latest?
Well, Francine, the controversy obviously continues. It has been going on for days. We all remember that World Cup win for the Spanish team and that kiss between the head of the federation and one of the players. And Francine, this is almost the gift that keeps on giving now. We have a federation that has decided to ask for the resignation of the boss, a suspension by FIFA, now potentially a legal battle whether or not there was consent in that kiss. The win has been eclipsed now by this moment, and now almost a bizarre turn in the saga, which not only involves Mr. Rubiales, he is the head of the federation, but actually his mom too, who it appears, as far as we know, that she's still locked up in this church on this hunger strike. And now what she says is that she's doing this in protest to what she believes are, quote, fake allegations about his son. The problem, of course, is that we all saw the moment play out on tape, and that kiss, whether or not it was consensual, that would play into what is presumed now will be a legal battle between both the federation, the now suspended head of the federation, and the player. Now, it's also worth stressing and pointing out that the Spanish government has interfered now in the situation, saying that he's no longer in a condition to lead the team, and there's also real pressure on the coach too for other issues that played out in the past. So again, it's a sad situation, almost bizarre too, and also it's a shame that the entire win has now been eclipsed by this incident.
Yeah, I have to say it is bizarre, but also very sad. Thank you so much for a terrific briefing, not only on inflation and some of the concerns on Europe, but also European football. Our Europe correspondent, Maria Tadeo. Now let's discuss the broader outlook for Europe and the global economy with Andrew Bell, Chief Executive, Witan Investment Trust, along with Bloomberg's Sofia Horta y Costa. Thank you both for joining us. I will not ask you about the football, although I'm very tempted to. When you look at the concern in Europe, rates could be in their peak, but when you look at a lot of the companies that have borrowed, I mean, we could be just at the beginning of, if not a recession, defaults, companies not being able to pay back what they've borrowed. Are you worried that it could turn all of a sudden?
Not massively worried. I mean, the surprise in the last 6 or 9 months has been how the US has not just not had a recession, but is actually booming at the moment, because they had a sort of rolling recession, and the bits that first went in are now coming out. And now I think the world's having a rolling recession, that the US is booming, probably set to slow down. China and Europe have hit the bumpers. The UK is kind of bumbling along in the middle. I don't think we're actually facing a major default crisis, but I think things are, people have underestimated after a decade when money was basically free, companies could borrow for 2 or 3%. Now they're having to pay 6 or 8%. That's going to put strains on, and some of these zombie companies that have kept going for the last decade probably going to go bust.
But so are you saying that it's companies that maybe don't deserve to stay on much longer that would be wiped out? And is that, do we underestimate the fact that if a central bank is going to bring inflation down from 9% to the target of 2%, then they will have to break things?
They don't have to do it in a year. I think one of the themes we've had in the last, actually since the beginning of the year, was that the peak in interest rates was going to be much more like Table Mountain, a plateau, than the Matterhorn. And I think once central banks have got confidence that inflation, having peaked, is now converging towards their targets, I think they'll be patient in the pace at which. So the Fed doesn't need to jack rates up to 7% in order to get inflation to 2% in a year's time. Ditto in Europe. I think there's more of a mindset in Europe that is disinflationary, because the ethos of the ECB is much more of the Bundesbank rather than the Garlic Belt. But so I think that something has to break. Yeah. Confidence has to break, but I don't think that the economy has to. I think, I mean, the central banks misread the surge in inflation, and they would lose more credibility if they crunched the economy and then had to be cutting hand over fist in a year's time.
Sophia, what does this all mean? So, I mean, if you see I guess the interest rate differential between the UK and Europe or the ECB, we always thought that the UK was in a much worse position, but then we have some pretty encouraging figures today, especially for food inflation.
I mean, it is encouraging. I think that's an important story, because it's not just where the level of inflation is, but also the direction and whether it's telling us a trend yet. I think that the market is trying to convince itself that actually the worst of the fight against inflation here in the UK is over. Maybe we could no longer need that jumbo hike at the BOE September meeting, but inflation is still very high. There is a much tougher battle here. Even though food inflation, grocery shop price inflation fell below 7%. I mean, sorry, that's not groceries, that's the overall. But grocery shop inflation is still double digits. I mean, that's still incredibly high. The overall economy prices are still climbing at a lot faster than the 2% target for the BOE. So there's still a lot of work to be done. And contrary to the US economy, like Andrew was just talking about, the UK economy is a little bit more fragile, significantly more fragile. So whether things break or not here, I think the line between the two, it's a finer balance for the Bank of England.
Yeah, and the labor market, without a doubt, is more tight here than elsewhere.
Yeah, it's very tight, but also only about a third, people estimate only about a third of the increase in interest rates has fed through to the housing market, because people are on 2 to 5 year fixes, and if you were on a fix 2 years ago, which was 1.5% for 5 years, when you come off it, it's going to be 6 or 7, and that's going to be so I think the Bank of England is cognizant of that. They will almost certainly tighten by another quarter, maybe a half, but I suspect that the economy is going to start showing the pain on the consumer side within the next few months, and that'll take the pressure off the Bank of England. And I think they will be patient. If it takes 2 to 3 years to get from 7 to 2, but you've got credibility in the direction of travel, then that's okay.
Is there a concern that actually a lot of traders haven't quite, I guess, priced in the fact that we could stay at these levels for much longer than expected? Markets have had a tendency to price cuts either here in the UK or in the US, and they may not come.
I like that Andrew's saying we need to be patient and central banks will be patient, but markets are definitely not patient. I mean, July was all about soft landing. Because of the data that we saw there, wage growth was strong and inflation was coming down. Then August was all about higher for longer. What will September be? I think markets tend to kind of look ahead and they want to focus on the bright picture. And Andrew and I were just talking before coming on the set today that what will the brighter picture be? Will markets be focusing on the economy, i.e. we will get growth, we're not going to get a hard landing, there's no recession in the US and we'll all be fine, we'll muddle through? Or will they actually focus on interest rates and look at that instead? So I think markets kind of need to decide. There was definitely a read from Jay Powell's speech at Jackson Hole that was a bit more hawkish, but markets were okay with that. And we saw the huge, very, very solid auctions in the US Treasury market yesterday, huge demand for that. So will markets be okay with higher for longer, I think will be the September question.
Yes, September is on Friday. We'll be back with Andrew and Sophia. Andrew Bell of Vuitton Investment Trust and Bloomberg Sophia Ortega-Costa. Both stay with us for a conversation also about China's economic slowdown. We'll have a full roundup of what we heard at Jackson Hole. Coming up, also, Chevron workers at its Australian natural gas export plants are threatening to go on strike. More on what that could mean for the global energy markets just ahead. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
More on the global economy with a special focus on China. Still with us, Andrew Bell, Chief Executive of Vuitton Investment Trust, along with Bloomberg Sophia Ortega-Costa. I've been mispronouncing it, but this is a council of wise men.
Yes, it was sort of Anglo-Saxon term for the local council, if you like. And it was all men then, but now nearly half our board are ladies.
I wonder what the wise men and women make of Country Garden. It's not looking good, Sophia.
It's not looking good. So this is China's biggest developer, or used to be at its peak, biggest property developer by sales. So this is no Evergrande. It's a well-run company. It was rated investment grade. I think it fell into junk territory in June last year. So how quickly it has fallen. Trying to delay its yuan bond payment. So this is due September 4th on Monday. And essentially what this says is that the Country Garden, the company is in a cash flow problem. It's not a debt problem like Evergrande, a cash flow problem because it's not selling properties. And we know this is a macro story for China, one of the most important macro stories. The property market is in a downturn and policymakers haven't been able to put a floor on that. So essentially it's saying we're trying to avert a default in the onshore market because that would really rattle sentiment.
And given all the concerns actually in China, you're still quite, if not bullish, you're less downbeat on China than most.
Yes, I think we've moved, for the last 2 or 3 months, it's been they're trying to do too little too late. And I think we're just getting to a point where they're clearly announcing measures almost every weekend. And I think they will keep on doing that until it works. So we'll get a tipping point. And I think the Chinese government will do what it takes to get the consumer confidence back up and to enable these property companies to refinance themselves or for the debt of the companies to be taken onto the national exchequer. So I think they'll come through okay.
All right, thank you both. Andrew, we have this great story about Citadel also vetting 69,000 intern applicants. Like, how many applicants do you get at
Not very many. We only have 6 employees because everything we do is outsourced. So
I was still expecting thousands of interns.
And they're looking for mathematical geniuses, aren't they?
They are.
And mind you, they can lose money too.
They can, but we now have AI. Andrew Bell, Chief Executive Officer of Wheaton Investment Trust, and Bloomberg Sofia Orta y Costa. Now, possible strike action is threatening more volatility in natural gas markets. Chevron workers at its Gorgon and Wheatstone LNG export plants in Australia are planning work stoppages next week. Well, Bloomberg's Will Kennedy, who oversees all of our commodities team, joins us. Well, Woodside workers able to reach a deal last week. What are the chances that Chevron can do the same?
So this latest vote was a little bit of a surprise, Francine, given, as you say, that Woodside had done a deal. I think the expectation in the market had been that the Chevron workforce would do the same thing, and that hasn't happened as we saw in this vote. However, it doesn't ensure that there's going to be a strike. There are several stages that need to go through before they would walk off the job. But we have seen in gas trading today that it's gone higher again, and so there is some renewed nervousness about the potential impact of industrial action in what's been a very volatile market in the last few weeks.
So, well, what's the likely impact on global gas markets?
Well, Europe is in good condition going into the winter. Gas storage is more than 90% full, way ahead where you'd see it normally. And it will reach 100% very early on in the season. So there is some confidence, but at root, without Russian supplies, Europe remains very vulnerable to any small changes in the global gas balance. And that's why their traders are so nervous about events in Australia, because although it's couldn't be further than Europe, it's a key supplier of liquefied natural gas, and any curtailment in supply there will have a impact into the broader market and could, especially if we get cold weather this winter, make conditions quite tight for European buyers.
Thank you so much, our Will Kennedy there, who oversees all of our, of course, commodities coverage for Bloomberg. Now, coming up, drivers beware. The ultra-low emission zone is expanding in London. We'll discuss the political implications next. This is Bloomberg.
In 2018, the IPCC did what was called the 1.5 report. What was the difference between what a 2-degree world looked like and what a 1.5-degree world. And the catastrophe to the planet between those two poles led everybody to conclude that actually the job is bigger. We have to go to net zero. And that's a transformation of the global economy on the size and scale that's never occurred in human history. So that's a kind of daunting task, but it's full, I think, also of challenge, opportunity, the chance for innovation, and the chance to have the private sector play a fundamental role in making that change happen.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, Telecom Italia is gaining this morning. That's after Italy approved a decree which empowers it to take a stake in its network business. The move is actually part of an effort by the Prime Minister, Giorgia Meloni's increasingly activist government, to assert more control over strategic assets. Now, for more on this, we're joined by Bloomberg's Milan Bureau Chief, Tommaso Ebhardt. Tommaso, good morning. So why is Meloni doing this?
Ciao Francine, buongiorno. It's quite interesting. The first act that Meloni did when she came back from her holidays in Apulia last night was approving a decree which allowed Italy to buy a 20% stake, that means about 2.5 billion euros, in the new network unit by Telecom Italia. It's quite surprising that at the end of this long saga, we see the government itself buying a stake in the former monopolies. It's showing, first of all, the strategic importance for the government of the network, and secondly, it shows the activism that Meloni is having the last few weeks in the Italian economy and the Italian business world. Investors are starting to get a little bit worried by this activism by the Italian premier.
So Giorgia Meloni is becoming increasingly active in Italian businesses. What's next, and are investors nervous?
Investors are getting nervous. We saw an unexpected windfall tax on banks, which was announced at the beginning of August in the last cabinet meeting before the summer break. Then we have Meloni now working on a new measure for non-performing loans. We have investors extremely worried because this new measure could jeopardize the non-performing loan market. We have Meloni investing directly in Telecom Italia. Clearly, after about 10 months, when Meloni was essentially managing the show of Italian politics without too much noise, she is now showing that she really has the power and she wants to leave a mark. Is this going to be welcomed by investors? There are some question marks about it.
Thank you so much. Our Milan Bureau Chief, Tommaso Ebhardt, with the very latest on Italy. Now, London's enlarged ultra-low emission zone, or ULEZ, comes into force today. High-polluting vehicles pay £12.50 per day to enter the expanded zone. That's on top of the congestion charge for inner London. Here with the details, our Bloomberg Green editor, Siobhan Wagner. Siobhan, thank you so much for joining us. This is huge. It's a big deal, and the map is getting bigger and bigger. Other European cities are also following suit. So what are the arguments on both sides of the aisle?
Yeah, well, it's interesting, and what we've kind of pointed out in our story today is that, the mayor is kind of getting it from both sides. Some people that think he's gone too far, some people who think he hasn't gone far enough. On the too far side, this pollution charge zone now is extended into the outer boroughs where people are more car reliant and statistically lower income compared to central London. So to kind of force people to maybe, change their car or pay a pay a fine seems a bit harsh now, considering, you know, we're in a cost of living crisis. On the other end of the scale, you look at kind of pollution in the city, and still, you know, the WHO would say that we're not kind of at safe levels for nitrogen dioxide. And some people have said, you know, ban all diesel cars. So either way, he's getting criticism. Yeah.
And I mean, this is a huge political, you know, hot potato, and we've seen it play out in by-elections here in the UK.
Yeah, so that's right. So because this is extended now into the outer boroughs, and one outer borough, one area that was up for election in July, Uxbridge, the former seat held by former Prime Minister Boris Johnson, it was just narrowly lost by Labour, and they really thought they had a chance in that spot. So as a result of that, and it's really because it's kind of ULEZ controversy got politicized there, and you know the Labour leader Keir Starmer asked Khan to have some reflection on the moment and maybe think differently about pollution policies going forward.
Siobhan, overall, I mean, could this be a blueprint for other big cities, or are there countries that, again, are looking at London, looking at the political fallout, and then deciding whether they implement the same?
It's interesting. So the mayors that kind of have spoken up and said that they're looking at ULEZ, they haven't really kind of commented so much on the controversy. I think what everyone's doing now is they're really trying to look at the results. Like, does it work? Is it going to reduce pollution? And if so, maybe the politics should be aside. This is the way we need to go forward anyway. Cleaner cars, cleaner air, yeah.
Siobhan, thank you so much, as always, for some great reporting. You can also find that story on the Bloomberg terminal. We'll push it out on social media. Siobhan Wagner, they're some of, our team leader, actually, for green energy. Now, we'll be covering all things at UK every week on Thursdays at 9:30 a.m. London time in our half-an-hour special. Here's what else we're looking out for today. The UK Foreign Secretary, James Cleverly, will be in China for talks focusing on Russia's war in Ukraine. At 1 p.m., we get Mexico GDP figures. Bloomberg economists see activity rising 4.6% year-on-year in June, but a recession in the U.S. is a main risk to growth in the country. Then at 3 p.m., U.S. consumer confidence data is released, and before the U.S. market opens, we got Best Buy second quarter earnings, which along with consumer confidence data will give us a picture on the strength of the U.S. buyer. Let's also look at some of the other things that we're looking at. Again, if you look at the U.S. two-year yield, probably the most important, actually, chart that you'll see today, hawkish more or less holding following the Jackson Hole two-year just below 5%. Higher for longer is coming to mind. We heard from Jay Powell. He spoke in a highly anticipated speech at Jackson Hole on Friday. He said that the U.S. Central Bank is prepared to raise interest rates further if needed, and that borrowing costs would likely remain elevated. That's going to hit yen. That's certainly according to Goldman Sachs. So let's also look at yen. The country with a very dovish central bank will see further currency weakness. And we heard it actually from Karen Ward of JP Morgan saying unclear whether central banks readjust to the Bank of Japan or whether the Bank of Japan readjust to other central banks. Up next, Bloomberg Surveillance Early Edition with Simone Foxman in New York and Danny Berger here in London. And this is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called Red Wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. Back-to-back gains. Stocks rise cautiously as investors await a deluge of economic data over the next few days for clues on the outlook for global central bank policies. Meanwhile, the UK's food inflation cools to its lowest level in almost a year, relieving some of the pressure on the Bank of England to keep raising rates. And China's gloom continues. Economists once again trim their expectations for the country's recovery as data flashes warning signs. Good morning, everyone. Welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger back in London. Simone Foxman is in New York. Simone, just moments ago, a great Bloomberg scoop breaking more policy efforts from China, potential policy efforts to try to weigh up support. Banks are weighing further deposit rate cuts to boost growth. Still, though, Simone, this market is waiting for the bazooka. It isn't waiting for these piecemeal efforts so far, having limited impacts on rallying the yen and rallying the Chinese equity market.
Yeah, and that bazooka not necessarily likely to come, according to a Bloomberg U.S. MLive survey of professional and retail investors. And perhaps that's why we're seeing U.S. futures roughly unchanged at this point, even despite these new measures coming out, though we'll see how that plays in to trading over the course of the day. We were looking at a U.S. two-year yield that had been below 5%. Now we're seeing that tick slightly higher, this coming after a massive auction of 2-year and 5-year treasuries yesterday. That was well over 5% yield, I should mention. Of course, we're always keeping in mind where we are trading with oil. All of this on the health of the global economy. China's Sinopec saying that it expects demand up 12.9% in the second half of the year, but that is slower pace than we saw in that first half. So again, the question mark, how do these Chinese stimulus policies play in, including the news this morning? But one thing I am watching is iron ore futures. These are trading in Singapore. And the interesting story is what's not happening here, because we would expect with a China slowdown, with a slowdown in construction, for iron ore to take a dive. But in fact, it's been rallying over 2% in the past 2 weeks, still off its highs, but perhaps a sign that China's problems are not as drastic, or the markets don't believe they are as drastic as they could be, Danny.
This is interesting. You have to look at specific places to see how this China trade is playing out. In equities, it's playing out different than metals. It's playing out different than what we're seeing in the yuan. Now, again, the news that broke just moments ago is that China banks are looking at further deposit rate cuts in order to boost growth. Simone, if that happens, it would be the third time this year, potentially. That tells you something about how far these efforts have gone and the impact of that, again, to boost growth, to have more borrowing, to have more construction. Now, the immediate impact, you can't see it exactly on the chart I have in front of me for our radio audience, but initially was a tick lower in dollar versus the yuan, so strengthening. That is reversed and continued the trend of a weaker yuan versus the dollar. That is at 7.30 at this very moment. Stocks, though, they look on more stable footing. We did see yesterday, right off the back, that huge gap higher when it came to the HSI, when it came to the Hang Seng. After those various announcements announced by the PBOC, announced by Chinese authorities, those gains petered out throughout the rest of the day yesterday. We talked about it a lot. But today we are yet again seeing strength in the Hang Seng session. I'll show that to you in just a moment. Let me first get to the Europe board, just a moment being now. So let me show it to you. Here's this huge gap higher we had. It just peters out. But again, today's session has been remarkably strong. That's bleeding into the European session too. If you look at Europe, it's moving higher. The best performing indices are those related to China. It is things like miners, for example, housing materials. So again, it is this strange thing where maybe iron ore doesn't believe it, but European stocks do believe it. We also had some UK data. We're going to get into that with one of our reporters in just a moment, showing that inflation, shop price inflation coming in. The European data, though, not looking so good. We are looking at a euro that is weakening versus sterling, despite the fact you think inflation would give the BOE more room to not hike. Finally, just want to point out Nat Gas, a huge rally yesterday. It's coming in today, weighing up more supply versus some of those strikes in Australia, potential strikes around the LNG facility. Simone.
Yeah, Danny, let's dive right into this breaking news. These Chinese mega banks weighing further deposit rate cuts in order to boost growth. This would be at least the third time in a year, and this based on Bloomberg sources. Bloomberg's China executive editor, John Liu, joins us in Beijing for more. John, talk us through the impact that we could potentially see if banks do go through with this move.
So there's two major impacts. One, we've seen an increase in the amount of money that households have put into bank deposits over the last 6 months or so. If the deposits yield less, there would be an incentive for people to take that money out and either invest it or spend it. And so that would be one objective. The other is that the banks want to keep their net interest margins intact. And so that means if they have to pay depositors less on those deposits, they can cut their interest rates that they charge for things like mortgages and other sorts of borrowing. So that could in turn spur more borrowing, spur more economic activity, and that could get this economy going again.
And it comes just off the back of data collected from various economists by Bloomberg showing that GDP is expected to expand 5.1% this year, John, versus the year prior. Before it had been 5.2%. Are these types of measures enough to undo some of the concerns that economists are starting to show about the Chinese economy?
I think we're going to have to see a turnaround in the data before we see a turnaround in the economic estimates that we're getting from economists. The 5.1% expectation, that is still slightly above the 5% target for 2023 GDP growth that Beijing has set. If we start falling below that, the more we fall below that, the greater the magnitude of measures that we will get out of this government.
John, U.S. Commerce Secretary Gina Raimondo is in Beijing this week. She's stressed the importance of stable economic ties between the world's biggest economies during her visit. Take a listen to what she said.
We agreed to establish a new commercial issues working group, a formal working group, which will involve U.S. and Chinese government officials, and very importantly, U.S. and Chinese commercial private sector representatives, as we seek solutions on trade and investment issues and to advance U.S. commercial interests in China.
John, talk to me about who she met so far, what's being discussed, and how does this play into tense U.S.-China relations?
Well, the most senior person she's met on the Strip is Premier Li Qiang. She's also met with Vice Premier He Lifeng, who's in charge of economic issues. She's also met with her counterpart, the Commerce Minister here in Beijing. The message that Secretary Romano has been trying to deliver is that trade, much of which between the U.S. and China is in products, goods, and services that have nothing to do with national security, can continue to flourish, even though Washington has put lots of sanctions and limitations on things like chips and other technologies that it feels hurts American national security interests.
And then on the UK side, John, China has also confirmed that the UK Foreign Secretary James Cleverly is going to be visiting tomorrow. What about that trip? What are we expecting there?
Well, we know that Secretary Cleverly wants to speak to officials here in Beijing about the Ukraine-Russia situation and what role China plays in that conflict. We're not as clear on what the Chinese side will want to discuss, although we have had a newspaper here in Beijing, a nationalistic-leaning newspaper, the Global Times, say in an editorial that the British Museum should return all Chinese artifacts that were taken illegally. So that might come up.
Yeah. Hey, China's not the only country asking for that, right? John, thank you so much. And again, a fantastic scoop from you and the China team, Bloomberg's China executive editor, John Liu. Now, let's get more analysis on how markets are trading as we wait a slew of U.S. data this week. Sofia Orta-Costa from our Markets Today team joins us now. Sofia, the disappointment yesterday had been those higher yields on the Treasury auction. The potential for volatility doesn't stop there. There's a lot of data. I'm going to be honest, I wrote it down in my notes, but now looking at it, it's too long for me to read out. But we're going to get non-farm payrolls, things like that. What is this week going to look like for us? Is it shaping up to be one of those very volatile summer-type weeks with this type of data?
I think the longer your notes are, Danny, the more volatile markets will be.
Oh, that's a bad sign for today.
I mean, yes, I do think also, let's just have a moment to just discuss yesterday's auction. I think there's a lot of focus on how high yields were. This is the market repricing the higher for longer narrative that's really become entrenched since that Jackson Hole speech by Powell. And I think there was a little bit of panic right after the speech, a little bit of confusion as well, plenty of confusion, but now markets are kind of growing comfortable with the fact that, okay, higher for longer, we're good with that. But the auction results were actually very good. I mean, there was demand at those levels. I think that's how we should be reading the auction results, and that's why markets are a little bit calmer now. And they were, I mean, the S&P rose yesterday, right? It's a market that's reassessing the outlook for interest rates and seems to be comfortable with that. Of course, we have jobs data. Well, we'll know jobs opening data today. That could change the picture again. Ahead of payrolls on Friday, it's set to be very interesting on the U.S. macroeconomic front. And again, what will the narrative be for September? If we had higher for longer in August and we had soft landing in July, will September really change the game? There's a lot of questions in the market right now.
Sophia, we also got data from the British Retail Consortium today talking about shop price inflation, falling sharply again to 6.9% in August. It had been up at 7.6% back in July. Talk to me about how this impacts the Bank of England's calculus with respect to its rate hiking cycle.
Yeah, so this is really interesting. Before the Bank of England decides on its next interest rate, that will be September 21st, we have this piece of data which suggests that inflation is cooling. Inflation is still very high, so it's a very different dynamic versus the US, where you have a strong economy and inflation is cooling a lot faster than here. Here it's a lot more entrenched, so anything that shows that price pressures are easing is good news and is taken to be good news by the market. So again, slowing to 6.9% from 7.6. What this sets us up for is perhaps another cooler than expected or cooler, I should say, because it wasn't cooler than expected, cooler inflation print from the UK in the next few weeks. But wage pressure is still very problematic for the BOE. So the debate has shifted from, when we got those wage numbers a few weeks ago, from whether the BOE will need to go for that jumbo half percentage point hike in September to whether just, a quarter percentage point makes sense and even maybe a pause.
Yeah, Sophia, thank you so much for all of that. That's Sofia Orta-Costa from our Markets Today team. Now, coming up later this hour, we're going to go around the world with Kit Jukes, head of FX strategy at SocGen. This is Bloomberg.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. All eyes are on the U.S. jobs report.
We're still seeing some lingering effects of the pandemic on the jobs market.
There has been a shift to labor, and it doesn't seem to be diminishing.
This labor market is still tight.
This Friday, the surveillance team brings you the crucial jobs data and expert analysis at terminal speed.
Are we beyond COVID?
We are on that path to get to lower inflation by the end of the year.
But then you look at the unemployment rate, you're looking at a problem for the Fed.
The August jobs report, Friday on Bloomberg Television and Radio.
It's been a tough August, whether you want to talk about bonds or you want to talk about stocks. Now, in this equity market, American equity has fallen so far this month about 3.5%, but there's been some good news. For the past 2 days, the S&P 500 has posted its first back-to-back gain of the month. Okay, maybe not huge, maybe just higher than 0.5%. But it's something. It's something following Powell's Jackson Hole speech. Let's go now to our Bloomberg's equity reporter, Farah El-Bahrawi. Farah, thanks so much for joining us. Look, 2 days of higher moves in the S&P 500, a grim month. Is there something to this, or is it just a pause of a seasonally rough month?
Well, the consensus, Danny, here is that Powell did not really surprise markets, and that was probably the good news that markets needed to stem the declines that we're seeing in August, as you mentioned. What's on the agenda for this week, you were just discussing the jobs report with Sophia. That's going to be really important. In fact, if it does, if the estimates that we have at the moment do materialize, it would be the smallest increase in job growth over the past 3 months since the start of 2021. That would be a step in the right direction that Powell is looking for. Similarly, their preferred PCE inflation measure, that would be if the 0.2% monthly back-to-back gain actually does occur, that will be the smallest increase since the late 2020. So these are very good numbers. Would it provide a lift to the S&P 500? I'm not sure. Maybe the market is looking for something a little bit more after such a strong rally, especially that we've seen in tech. But it's definitely helping that seasonality that we've seen in August. But keep in mind, September is also another rough month for equities. So maybe it's not all clear skies from here, but this data will be very, very important.
Farah, let's dive into what strategists are saying about tech. I mean, we had those really blockbuster earnings from NVIDIA. That was supposed to drive everyone's enthusiasm towards AI, and then, shares not really going anywhere. What are strategists telling you about the prospect for that sector going forward? Can it continue to drive gains in the stock market?
I will look to Bank of America's Michael Hartnett. I love his notes. In fact, on Friday, he said that the second half will only bring trouble to the tech sector and not a new era of AI rule, as he called it in his note. This is because the NASDAQ 100's performance and central bank assets have been very closely correlated over the past 15 years. So with central bank assets falling $3 trillion since the start of this monetary tightening cycle, it does not make sense for the NASDAQ 100 to be making new highs. Similarly, we've had warnings from RBC Capital Markets saying that tech, or at least the growth trade right now, is overvalued, overowned. They're fading in terms of earnings dominance, and flows have turned to negative from positive. And for European stocks specifically, Barclays is saying that it's not going to be indiscriminately affected by the AI rally, even if we do see one in the US. So more and more cautious voices on the tech sector after a massive 37% rally.
And Farah, quickly here, I mean, you mentioned Europe. I'm assuming that China is not going to be that big of a help. Is that another concern for this European equity market?
Massive, Danny. It's, what strategists have been talking about, what investors have been talking about. They're genuinely concerned, especially for those stocks tied to China. We had a JP Morgan's Mislav Mateshka this morning saying that miners, autos, capital goods, they're very closely connected to China's stock correlation. And they did say fade any bounce tied to the China rally. It has to be a massive stimulus coming out of China for it to translate into Europe. So a very big headwind for the sector.
Farah, great to get your thoughts today. That's Bloomberg's Farah El-Bahraoui. And for more market analysis and live go is where you want to head on your terminal. This is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready? Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Simone Foxman in New York. Now, Goldman Sachs has struck a deal to sell an investment advisory business aimed at the mass affluent market to money manager Creative Planning. Bloomberg's Sue Keenan has the story.
This is a move that underscores Goldman Sachs is refocusing on what it does best, managing the money of the ultra-rich. The sale of the investment advisory unit is related to failed forays into consumer banking and efforts to market its services to the mass affluent class, the mere millionaires next door. Goldman has now agreed to sell the investment advisory business that grew out of its purchase of United Capital just 4 years ago. That unit has $29 billion, and Goldman not revealing the price, but says it expects to recognize a gain when the deal closes. Now, this is in stark contrast to the other sale Goldman is pursuing, the divestment of its consumer lender, GreenSky, at a steep discount, just over a year after it completed that takeover. Bloomberg has learned that the sale is now in the home stretch, with groups including Apollo and 6th Street working on what's poised to be their best offer. As for Creative Planning, the money management firm buying the investment advisory unit, it is run by Peter Mallouk, who's written several investment self-help books. His firm already has a custody deal with Goldman, and he said that expanding that partnership is a great strategic fit. Sue Keenan, Bloomberg, New York.
Now to today's big take, which takes a look at the ultra high-end summer coding camp that Citadel interns attend in Hong Kong. Finding and hiring the next generation of math and computer whizzes is a competitive business, to say the least. Median intern pay has jumped at top U.S. finance firms, with Citadel topping the pay list. Summer camp attendees are treated to business class flights, 5-star hotels, luxury networking dinners, and a rigorous program of trading simulations as the brokerage giant seeks to woo the very best young talent. Simone, if I can be reincarnated in this life, I would like to be reincarnated as a Citadel intern, I have decided after reading this story.
Yeah, at what, $19,000 plus a month. This is a great read by Lulu Yilan Chen. They're talking particularly about the Asia division, which is so important for Citadel's business, highly competitive, and that's why all these things are being offered. But, you know, such a shift from just a couple years ago when I think hedge funds didn't really even offer summer internships. They were looking for talent that was already at banks to poach, now going straight to the source, going straight to schools.
Yeah, the one thing I will say, Simone, that makes me kind of hesitate as to how appealing this is, it kind of sounds like a weird experiment. For example, the story points out that they're not aware of it, but they're kind of being monitored the whole time. And one of the things that they use to decide whether or not they want to hire someone is their interaction with other interns, how they speak, how they problem solve. You're literally always being watched. Which again feels like also a Big Brother mixed with interning. All right, anyway, coming up, we're going to get back to the market, speak with Kit Jukes, head of FX strategy at SocGen. This is Bloomberg.
going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Back-to-back gains. Stocks rise cautiously as investors await a deluge of economic data over the next few days for clues on the outlook for global central bank policies. Meanwhile, in the UK, food inflation cools to its lowest level in almost a year, relieving some of the pressure on the Bank of England to keep raising rates. And a new Bloomberg scoop. China's biggest state-owned banks are considering lowering deposit rates for at least the third time in a year. This move comes as lenders ramp up efforts to boost the economy and to protect margins. I'm Simone Foxman in New York with Danny Berger in London. Danny, it's interesting to see what the impact is when China announced these support measures. Earlier this week we were talking about the support measures for stocks. Now it sounds like banks may be getting into the action once again. Does it impact Europe? Does it impact the United States? We're going to be so focused on how this plays out.
Hey, look, at least for the time being, European stocks are moving higher. And the ones that are moving higher do seem to be China related. So something is having an impact. How widespread it is, that's perhaps another conversation for us to have with Kit Chooks in just a moment. European equities up 0.5%. Simone, again, it's miners, construction materials. That's what's leading us higher. Euro versus sterling, that is weakening. We're looking at a weaker euro, some Germany data, some confidence numbers coming in, a bit disappointing as expected. UK shop price inflation coming in, but still not necessarily meaning that we're looking at a weaker sterling. We're looking at a stronger one today. Then finally, just want to point out nat gas, because this thing has been so volatile. It's the supply from Norway, more of it, that we have to weigh up versus potential walkouts at an Australian LNG plant. For the most part, that sent nat gas higher, but today coming back in by about 4%, Simone.
Yeah, Danny, in the U.S., S&P futures roughly flat at this point, not seeing a huge impact from this new story we have out on China. U.S. two-year yields just trying to hang out right above 5%. This after a massive auction of 2-year and 5-year treasuries yesterday that saw the 2-year yield well above this 5.0 handle. Of course, watching oil very closely as this gauge of the global economy in China. Again, bringing up China, Sinopec saying demand for the second half of the year was going to slow down for its products. But if you want a positive one on China, iron ore futures, they're not doing a whole lot of anything. In fact, this number was a little bit weaker earlier today before that headline crossed on some of those potential measures from Chinese banks. And the story here, really, that iron ore is holding up, even though we're hearing all of this weakness in China, all of this negativity, and how the property market is playing into broader financial stress. Danny?
I want to dive more into the China story. I want to give us a quick one-day check on the yuan. We are seeing some weakness versus the dollar after that Bloomberg scoop of, again, China potentially stepping in some of the biggest state-owned banks by lowering deposit rates. So it was a pattern of weakness already to start the day, just accelerated. Joining us now is Kit Jukes, head of FX strategy at SocGen. Kit, in the past, in 2016, when we saw substantial weakness in the yuan, you saw state-owned banks step in to support it. Are we now looking like we're heading at that level again with these sort of piecemeal type actions?
Yeah, you get the impression that that the Chinese authorities don't particularly want a weaker currency. It doesn't help them. They've tried in the past to use it as a solution, and the side effects are worse than the benefits. Is I think the judgment, but. They clearly have a problem. I mean, they have an interest rate problem. If they want to cut them further, rate differentials get bigger. They have a growth problem, and they seem to have a capital outflow problem that's getting bigger again now. So, yeah, they'll smooth it. I'm not sure they can stop it weakening. I think that's kind of, so they'll probably just try to keep control of the situation.
Paul Dobson from our MLive team had this really great quote, basically likening what was happening in China to a colander, trying to fill up water in a colander, that as much as, local people put money into the market, international money is still going to flow out. Is that fair?
Yeah, I mean, when you're starting with a big current account surplus, you typically you're in a position where you have a fair amount of control over where your currency is. When you've got as many foreign exchange reserves as they have, likewise, you have a fair amount of control. But you have to be very hard-headed about going in with a big hammer to try to stabilize things. And I think that it would look to me as though the end decision is not quite colander, but it's just kind of massage the move. Yes, we'd like it not to happen, but we're not gonna cause lots of mess to try to prevent it.
Kate, you talk about yuan weakness. We did a survey. Bloomberg did a survey, our MLive poll survey, and retail and professional investors there were thinking that we'll see a 7.6 on the offshore yuan to the U.S. dollar by the end of the year. What are your thoughts on that?
Well, our strategist out in the Far East has that as his forecast, so I'm not going to argue with it as an idea. It's a good starting number. I'll tell you what my reaction to it. It makes forecasting a stronger yen really testing for me. That's really what it does as a knock-on effect. Look, I think a weaker yuan, and that's not a huge move, but a weaker yuan effectively makes the real effective exchange rates of everybody else stronger, particularly people who do a lot of business with China, which particularly includes Australia, Germany, the Eurozone in general, and Japan. And so, it's do we want all of our currencies to get stronger, through side effects? Is that going to help us at this particular point in our lives? Not everybody.
Yeah, let's stick to Japan because we saw the jobless rate coming in higher than expected in July. It was 2.7%. The street was looking for 2.5%. How does the Bank of Japan kind of balance that with what could potentially be a stronger yen, just given what we're seeing in China?
Well, so I think they balance it by kind of probably further dithering and not rushing into any kind of move with yield curve control normalization. They'll have, they're trying to manage the fact that with rising bond yields everywhere else, there's upward pressure on JGBs. So what do they want to do about trying to manage yields on JGBs? But if they let JGB yields go up, they'll get a stronger yen, and then they'll get inflation falling faster than they'll want to. So I think they're hoping that doing nothing will get them out of jail, and the rest of the world won't make it too difficult. Again, except for yen forecasters. But I think that this just adds to the reasons why a central bank that doesn't really want to rush policy normalization doesn't have to.
Yeah, Ueda doesn't want to be that guy that finally undoes the first bit of inflation that Japan is seeing. Would you agree with Goldman then that the risk, if they go slow, if they do nothing, is 155 on dollar yen?
A bit. I mean, 155. It's in real terms. I mean, the yen is The yen is 40% cheaper in real terms today than it was when we were last at 155. So these are crazy levels, and yet I'm not sure that it's doing very much for their exports that I can see sort of jumping out at me. But I think, more seriously, I think where the yen goes is very much a function of yield differentials, at least, if not, which is really, if you don't change anything on yield curve control, that's all treasury yields. I am inclined to think we're closer to the peak in treasury yields than that. But if we spike yields up significantly further, yeah, that's just what's going to happen.
If we're close to the peak in treasury yields, I mean, we've been so used over the past few years or the past decade to be trading on yield differentials. What takes over is the trade if we're near peak yields in the U.S.?
We just go sideways for a bit, but we're waiting for a policy move out of Japan, which would be a bigger deal in the sense of anything else. But otherwise, look, if we got yields going back towards 3% in the U.S., you'd get dollar yen going back a long way down. But again, that doesn't feel like what's happening today or this Friday unless we have a big surprise. So we are very much beholden to what's happening to treasuries.
Kit, thanks for that. You're sticking with us. Kit Jukes of SocGen there. We'll talk Europe. We'll talk the U.S. We'll have plenty more coming up on the program. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
This is Bloomberg Surveillance. You're watching the early edition. I'm Danny Berger in London with Simone Foxman in New York. We're back with Kit Jukes, head of FX strategy at SocGen. Kit, we're just discussing Japan. We're just discussing China. So let's bring it over to our region, to Europe. We were talking in the break about the pessimism over Europe, the weak European data. How do you decide if that pessimism is overdone or not? What do you look to?
So the PMI data in particular in Europe are a bad indicator of anything very much. So what you look at is for other stuff to go the other way to give you some comfort, which doesn't include things like this morning's consumer confidence numbers in Germany. So those numbers all weigh on the confidence of anybody who wants to believe the European economy isn't just heading into a recession. The China news is worse for Europe than for the United States. All ends up. So there's plenty of bad news. So what Europe needs is to show that the degree of pessimism about all of this stuff is now a little bit too big. Some upside economic surprises that can put a little bit of get the market thinking that not only could the ECB raise rates again, which is no longer priced in fully, but that it's not a dumb idea.
I mean, the hawks would say just that. We've heard from Holtzman recently, a lot of the hawks saying, look, we could easily go again in September. September's just around the corner, but there's still this stark divide. Is there a camp that seems louder to you at this moment?
No, I thought the message from Christine Lagarde was forcefully, we are going to get inflation under control. We're not changing our target, but from both her and Jay Powell, really, in that sense. I did immediately. I just had this earworm. That's the plan. Everybody has a plan till they're punched in the mouth.
By the data.
By the data. So in that sense, they just need some better data.
Yeah.
And at the moment, the news flow's bad and sentiment's probably worse.
Can take me through how the data is setting us up this week in the United States. We have that all-important jobs data coming out. How much of a toss-up do you think this next Fed meeting is, because we didn't really get that much clarity out of Jay Powell last week?
I got the sense from Jay Powell that we're on a pause now that probably lasts through September, but again, we've got another CPI number before that next meeting as well. So we've got plenty of data. We've had this period of 2 full sets of data between Fed meetings that we knew was coming. But I think it's potentially a longer pause. I think the issue with the US, in a sense, is if the economy doesn't slow over the course of the next couple of months, the next rate hike could happen further out, and a bunch of people's forecasts will be wrong. So that would be a bigger danger to me. And in that sense, I think I care about the data not as an indicator of what they do to short-term rate expectations in the short term, but more, as an indicator of, is this economy still slowing steadily? Or is the optimism about the Q3 GDP numbers, or that some of the things we sort of, I came back from vacation feeling that there was an enormous amount of optimism about the US economy that I was struggling to find in the data. The data again will tell us quite a lot in that sense.
Okay, so if we push that second rate hike, the next rate hike, say, a little bit farther out on the timeline, how does that play in with the dollar? Because then perhaps we see Europe sort of slowing down a little bit in its hiking cycle. Just take me through how that calculus works out.
Okay, so I start with a view that there's a recession. We've had a forecast of a US recession in the first half of next year since the end of last year. So kind of watch the market go one way then the other way. I still think that's the right forecast to have at this point in time. If it looks as though that just isn't happening, that the Fed needs to start again while China has its Minsky moment and Europe suffers, then king dollar is going to be king dollar, and the euro is going to be in a fair amount of trouble, and I'm going to be trying to work out whether euro dollar is going to go back to parity. And I'm scratching my head and losing what hair I've got. So I think that's what's in play. If the Fed is going to start again, I think we're going to get a significantly stronger dollar in the next leg.
Or were you on holiday in the U.S.? Because I was going to say, because then timing that with Jackson Hole is, I feel like that's kind of one of your calls there if you were in the U.S. trying to time it. I feel like that's maybe how you do holidays on currency pairs. Okay. I mean, look, we're in this place where Powell, I mean, he said so before, but it feels different this time, perhaps it doesn't to you, of talking about data dependence, saying we don't really know what we're going to do. It's going to be based on the data. But over the past, decade, we've been so used to trading on the Powell put, on the rate hike cycle, what they're doing, not what the data is. Is it different this time on what we trade and how we trade the data?
Yes, in the sense that, remember, the Powell put, in the past, because we haven't had that much inflation, as in almost none, in a crisis, the only kind of crisis that mattered was, oh no, the economy's weak, there's something wrong. You're not really fighting inflation, you're trying to normalize policy to get it to the right place, to kind of, do some quantitative tightening to get the balance sheet under control, so you can ease when you have the need to. That is not the case today until we get inflation down. So if we have a residual inflation problem, because we've still got a very tight labor market, because Americans still haven't completely depleted their excess savings, and if the Fed has to start again, then that's what they'll have to do. Equally, if the economy starts to lose some momentum, but the inflation numbers plateau at an uncomfortably higher level because the labor market's still tight and we've got all these things there, then then they're going to be scratching their heads at the Fed about what to do. And that's where, the whole failure to get into debates about R-star and what you do and all of that, I thought that, that is an issue that at least Jay Powell wants to boot down the road.
I was going to say, they didn't talk about it in Jackson Hole, the whole R-star, which disappointed a lot of people. They didn't get there.
Yeah, and I think part of the reason is, it's a difficult conversation. If they put out a paper on it, we'll all be over it like a rash. I'm saying, look, if you believe in real rates and neutral real rates and things, then surely you are cutting rates next year, and conclusions like that. So, I think this is where policy is difficult, because you're trying to balance conflicting needs. Keep it simple.
Keep it simple. Kit, thanks for diving into some of the details here with us, trying to make sense of it all. Kit Jukes of SocGen joining us. Thank you. Coming up, a look at some of the market-moving events to watch throughout the day. This is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO, so buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London alongside Simone Foxman in New York. Now, Hurricane Idalia is set to rapidly intensify, bringing life-threatening winds and storm surges as it barrels towards Florida. Idalia is set to make landfall on tomorrow, and depending on the exact track, the storm could cause as much as $10 billion in damage and losses. Something we'll continue to watch. Now, along with other things we're going to be watching out for today, we're going to have U.S. bank regulators, and they're expected to propose new regulations for mid-sized lenders. That includes a plan to require that banks as little as $100 billion in assets issue enough long-term debt to cover capital losses. Now, on the data front, we're going to get U.S. Conference Board consumer confidence numbers that will hit at 10 a.m. Eastern, and we're going to get some earnings today. That includes Best Buy, NEO, and HP. Simone, what you got on the stocks front?
Yeah, watching a couple different things. I'll kick us off with Bank of Montreal reporting results just a couple of minutes ago. Adjusted earnings per share missing estimates here, but a lot of the focus was on their acquisition of Bank of the West because they completed that acquisition back in February, and there was a lot of bank stress, as we know, particularly in regional banks since then. And the bank saying that record revenue in Canadian personal and commercial banking, but also a contribution from the Bank of the West drove some pre-provision, pre-tax growth this quarter. So we're going to be digging through there, try and get to the details about exactly how much Bank of the West was impacting those shares. We're also watching some earnings expected before the bell, Best Buy as well as NEO. So for Best Buy, we're looking for U.S. comp sales to fall 7.4%. But here, the real focus is demand for electronics. It gets most of its revenue from the United States, and that's kind of where we're going to see that weakness. But the company a little bit more optimistic about the third quarter and the fiscal year 2024. We're expecting estimated comp sales for the full year at negative 4.3%. With NEO, the car maker there, really looking at gross margin per vehicle to improve for the first time in over 2 years. Analysts expecting that margins are going to go up to 7.7% from 5%, but that the company needs to demonstrate more economies of scale, in order to get that number into double digits, Danny.
Now, look, Simone, I have to admit, I've been off for the past 2 weeks, and on a 2-week holiday, one tries to turn off and disconnect from work, but here's a story I could not disconnect from. It is VinFast, the Vietnamese EV maker that IPO'd in the U.S. Its market cap is now worth more than Goldman. I mean, this thing has had some huge moves, too. And I happened to be on holiday in Vietnam, so I saw a VinFast car for the first time. Simone, I quickly want to bring us some breaking lines coming out. China will be cutting rates on existing mortgages as soon as today. Again, this is a scoop from the Bloomberg team. About an hour ago, the team had a scoop that local banks, large ones, you think of the likely suspects, are also likely to lower deposit rates. Again, all of this an effort when it comes to mortgages to try to prompt more spending. Again, cutting rates on existing mortgages as soon as today, that's the scoop. And when it comes to the deposits, to take money out of deposits and spend it. Simone, you and I have been talking all day. Are these piecemeal measures, these and the ones we got over the weekend, enough to move the needle? We're just talking with Kit Jukes about the yuan, about that moving things like the yen more than perhaps some of what's happening in rate differentials at the moment, at least. And we are looking, we just saw the board there, some of the losses in the yuan start to reverse.
Yeah, and actually earlier this hour, China, the finance minister there vowing to strengthen policy support and speed up government spending as the economy's recovery comes under strain, making these comments to the legislature earlier this week, but being reported just a few minutes ago. But, you know, I think the thing is that folks don't really see, investors, traders don't really see that all-out bazooka that they ideally are been hoping for that would really change the narrative with China, and that making it difficult to kind of position appropriately, and of course impact of siphoning through into Europe, especially in the United States.
I love this line from MLive's Paul Dobson. China's quest to attract new money right now is a bit like trying to fill up a colander with water. Even if funds flow in, international investment continues to take flight. It's the challenge that China faces. Are what they doing enough to bring in the money? All right, that's it for Early Edition. Surveillance, the OG one, is ahead. This is Bloomberg.
forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
This is Bloomberg.
We're growing above trend. We're certainly seeing surprising resilience in many, many areas, and that resilience may continue.
I do think the strengths may persist into the next year.
As we look out 3 years, we will have seen peak inflation. We will have seen peak Fed.
This pause period has continued to be moved out.
We do think there is quite a bit of fragmentation in the economy right now.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The first back-to-back gains on the S&P 500 of the month so far, which tells you a little something about the month of August. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance, live on TV and radio, alongside Tom Keene. I'm Jonathan Ferro, together again this morning with Katie Lyons. Your equity market positive by 0.1% on the S&P. TK Jobs Week begins right now. It starts a little bit later with job openings in America.
Well, it starts with the JOLTS survey, and then we go on to the usual ballet Thursday claims and on to the jobs report. But far more, we have housing data as well. We forget Case-Shiller's a little grim. Well, you know what? We're going to get that measurement. I mean, it's not like China where the government's going tick by tick, headline by headline, but I got a quiescent data screen that I think is deceptive, and it's good to start strong with Chris Verone.
I saw the headline across the Bloomberg, Tom, on China, the prospect of cutting mortgage rates. Can you imagine? Can you imagine that happening here stateside, cutting mortgage rates? I think a lot of people who want to buy a house crying out loud for that one right now.
There's a real desperation over there, and I got to admit I'm constructive that they work it out like they have every time for the last 30 years back to Deng. But over here, it's about the economic data, and we forget in the dregs of August where you can't get the close, you have to have opening day.
What are you talking about? You're talking about back to school. It's back to school. We're doing back to school.
Everything's sold out. I don't have nothing to wear opening day.
You started late.
First day of school. Of course you started late. It's America.
Okay. That's what we do. We start late in America.
Start late in America.
I'm still holding on to summer.
Yeah.
When the weather's good in September, as far as I'm concerned, that's still summer. If you go through things piece by piece in China, just another headline full of news on my Bloomberg terminal right now. You've got mortgage rates potentially being cut, Katie Lyons. You've got the biggest state-owned banks considering lowering deposit rates for the third time in a year. You've got the Chinese finance minister talking up strengthening fiscal support. What isn't there to talk about in China this morning?
Well, the thing is, we're talking about them all separately. Piece by piece is the right characterization. This is piecemeal policy work that they are doing to try to shore things up. Just the latest line, of course, is on these mortgages for first homes only, but that is the bulk of the $5.3 trillion mortgages outstanding in China, something like 80 to 90% as of the latest data we have. So clearly trying to shore up growth in this economy. The question is, if they're doing it piece by piece, nothing seems to be a full bazooka. Is it going to do anything?
Is it going to do anything, Tom? Hasn't done anything to this market, has it?
No.
That was the real test yesterday.
The data. I mean,
Kelly was on top of that. We had a 5% move yesterday off the back
look,
of
I got a tie that matches
limiting IPOs. Have you matched today? Is that what you've done?
We're matchy.
Okay, let's return back to the market.
This is our UVA
TK,
look.
3 minutes in, focus.
I'm focusing.
Focus.
China.
Cutting stamp duty, limiting IPOs, asking some funds to come in and buy the market. Don't sell too much. It hasn't done enough.
I'm going to go to renminbi, 7.29 on yuan. I think the market data in commodities, iron ore and such, is not the panic that you see coming out of their domestic affairs. And there's a separation of China as exporter, manufacturing machine, we all know the ballet, versus their domestic challenges, which is their 30-year experiment to quote-unquote boost consumption. Guess what? It hasn't worked.
For the record, your bow tie is a mess. It is a mess.
No, it is. Well, so is the UVA
mess.
football. So,
Right,
you know.
You should fix. I don't know what that is this morning.
No, Lagarde tied this.
What is that?
There's like a sagging side.
Lagarde wanted me to wear this.
Is
tie.
that a new one?
Hermes. No, it's ancient.
Okay.
You know, like me. No, but it goes with Kaylee. It's a look. It's a Cavaliers. The Cavaliers.
Very glad we can coordinate this morning, Tom.
I did not get the memo. Let's get to the price action. The equity market with the lift here on the S&P 500. I mentioned it, the first back-to-back gains on the S&P 500 for the month so far. It's been that bad in August. Could be the worst month of the year, depending on how we close up a little bit later this week. Futures up in the bond market, yields a little bit lower, down about a basis point here, Kaylee. Your yield on a 10-year, 419.42.
Yeah, and of course, yesterday you saw that 2-year and 5-year auction, the highest levels in yields we've seen since before the financial crisis, talking 2006, 2008. So it really speaks to the pressure we have seen in this bond market. What clues will the bond market take later on today from the economic data we are going to get? You guys talked about it already, JOLTS at 10 a.m. We are expecting 9.5 million job openings. That would be the third month in a row of it essentially staying stagnant, looking at supply and demand in this labor market, especially after Chairman Powell in Jackson Hole was talking about how the Phillips curve may have steepened, that maybe you're not going to see the labor market deterioration as inflation comes down this time around. Then at 10 a.m. Eastern time, we also get some consumer confidence data from the Conference Board. We're expecting just a slight tick lower to 116 from 117. But as we've seen prices at the pump climbing, inflationary pressure is still sticking around, even if that pace of increase is coming down. How much pressure is that putting on the consumer? And then finally, also at 10 a.m., it's going to be a big hour. An FDIC open meeting. They're expected to propose requiring that banks with $100 billion in assets or more issue enough long-term debt to cover capital losses. This is yet another regulatory response we could see to the bank failures we've seen this year.
And the bank failures, we saw San Francisco's head of supervision is retiring.
I noticed that,
October 31st.
You know, I think that folds right into this.
Trying to do that quietly.
Is my tie better while she was
It's a little bit better.
briefing on?
It's a little bit
rebriefed my bow tie.
Keep working on it. Chris Verone with us around the table, partner, head of technical and macro strategy at Strategas, a bad company. Chris, good morning to you.
Great to be here.
Is it time to buy that story in China?
I would say this. I wouldn't be short. Think about how terrible the news flow has been the last 3 or 4 weeks. Probably the most bearish news out of China I've seen since 2008. And what hasn't broken down? Iron ore, Tom, to your point, has not gone down. Copper has not broken down. The Chinese 2-year yield has stopped going down. So I think the price action doesn't reflect the bearishness from the news. As someone who tries to marry how does price action versus news interact every day, it will be difficult for me to be here short and comfortable with that when I've gotten every piece of information in the direction of the bears and price won't break lower. So I think at a minimum, cover your shorts and open your imagination to the idea that something might be changing there.
Chris, you and I are trend-based analysis. There's a stochastic catching a knife in the dark and getting on a trend, staying on a trend. The trend you're most interested in is oil. I link oil demand directly to a Pacific Rim recovery. Am I right to do that?
I think we can link it to a number of inputs, that certainly being one of them. Limited supply. I think the supply side of this is equally as important. But at the end of the day, we've had this just bearish onslaught of Russia news and of China news. And what hasn't gone down is crude. Crude's bottomed. It's positive in our trend work. I think Brent's on its way to 90 here. Look how the energy stocks, after a pretty meaningful consolidation or pause this year, have just regained the flag of leadership. When I look sector by sector, there's not another group that has, say, 90% of issues above the 200-day that has relative leadership inflecting again. That's the energy sector.
What does Exxon do? Just as one example, what does XOM do? I mean, basically, it hasn't gone down as oil went from 120 to 70, whatever, back up to 80 as well. Is oil catching up to the equity stocks, or do the oil stocks surge ahead of a recovering oil.
You know, Tom, I think one of the things we try to do in our work is understand the regime we're in, and therefore we know what rules to play by. I think for so many years, every single rally in crude was one you could sell. Every time the energy stocks bounced, you should sell them. This is a different regime. We've had 6 months of a benign consolidation in energy, and now it's reasserting itself. To the point on Exxon, what I'm encouraged by is a lot of the return to leadership from energy has come without the major integrators doing a whole heck of a lot here. This has been the service names. This has been the E&P names. Look at some of the big global names here as well, which have all really reignited in terms of a leadership story.
Okay, what about elsewhere in cyclicals, financial stocks in particular? I know you're looking at some of the banks. We were just talking about how we're continuing to see the ramifications of the failures we have seen this year. What's happening in those guys?
I think if you told me that the bank index would be down 15% year to date, I wouldn't guess the S&P would be up 15% year to date. We went back yesterday and looked at every major S&P low over the last 100 years. This would be the first time in 100 years where you're nearly a year off the low last October, where S&P is up some number and banks are actually down. It would be more normal if banks were up 70% here. They're down 15 from where they were last October. When you go name by name, it's just odd to me that Citigroup is back on the lows, Bank of America's right there, Goldman and Morgan Stanley look weak, and we know the regionals have rolled. I think it's difficult to entirely dismiss that. I think the benign explanation is, listen, 50% of the S&P is above the 200, 50% is below. It's a very, very split tape. What I don't like is on the wrong side of the split tape, you have some pretty important groups like banks.
So if you're saying we're too pessimistic on China, are we too constructive on the United States?
Yeah, I think we're probably too constructive on Europe, which I think is deteriorating right now. Like, look at 3-month low German DAX, 3-month low French CAC. And, what drove a lot of those markets were European luxury names. Those have all rolled here. European discretionary has rolled. So, in a way, go back 14, 15 months ago, Europe was kind of first to bottom and turn up and lead. That seems to be flagging here. So I think before you talk about U.S. at major risk, I think there's a change going on in Europe. You see it in Euro-USD cross as well, which has come in sharply as U.S.-German rate differentials have changed.
So what am I positioning for? Dollar strength? What are you looking for? Where are you positioned to take advantage of that?
What's funny is I think it's interesting how consensus short dollar is, yet dollar's really not going down almost against anything I pair it against. In a way, Tom, it actually makes energy's resilience here even more noted, that it's happened even as dollar has firmed. But dollar's firm against yen. It's firm against euro, it's firm against sterling, it's firm against CNH. So hard for me to really embrace the short dollar call when it's just not on the charts.
And I'm looking at BBDXY, which is a blended bank index, which includes a lot of emerging market in China as well. And to be kind, it's well-behaved and center trend on the trading envelope, 2 standard deviations as well. You suggest that breaks stronger?
I think if you look pair by pair, it's hard to come up with a really compelling short dollar call here. I mean, even like Aussie USD, right? That's been soft. I think the pair you ought to focus on here is actually Euro CNH. Euro has been so strong versus CNH for the better part of the last year. That actually seems to be changing here. And I think it's in step with this idea that something's changing with China. Perhaps a stronger CNH relative to Euro is one more sign in that direction.
You've got a call for Lagarde next month, September 14th.
When I look at, say, German rates as kind of our barometer here, they've effectively been in this range for the last 6 or 7 months. My experience in this business is always surprises break in the direction of the trend. And I think the trend in global rates is still up. So I think if there's a surprise, it's rates have one more last push in them. That would be our guess.
Chris, this was awesome. Thank you, buddy.
Thank you.
Thank you. Chris Ferrone, a strategist there. If you want a call on the FX market, Goldman Sachs out with the call on the FX market. 6-month call, dollar yen. They were looking for 135, TK. They're now looking for 155 on dollar yen. They're going back to the 1990s on the Japanese yen.
Governor Ueda had the chance to clear the air at Jackson Hole. From what I can tell, he did not. There's a huge uncertainty there. And here, what you said, John, 135, and the Goldman Sachs calls what?
They're looking for 155. The call wants 135.
147 right now, and I would say Kitchukes and others are really heightened here at 147, 148. I don't know where you break through 150, but I'm sorry, the Bank of Japan, the Ministry of Finance, will defend the yen on the path to 155.
You've got a level in mind there, Chris, for when that happens for the BOJ. Higher.
Higher.
How much higher?
Weaker yen.
I'm drawn to the 55 number. It's an important Fibonacci number, actually, if you look at kind of the long-term dollar-yen chart. But you kind of can't have both ways. You're either going to defend the bond market or you're going to defend the yen, and I don't think you can do both. The big winner, though, I think, is domestic Japanese assets. If they're doing everything they can to keep money at home, I think Japanese bank stocks reflect that. They're the strongest bank stocks anywhere in the world. I don't think that's an accident.
Chris Ferrone, got to thank him twice. Should have stayed on Japan, Tom, just a little bit longer.
Yeah, well, I think there's a huge opportunity there, and it's unplayed in the Western media. No question about it.
Microphone, TK, just a little closer.
Yeah, it's over here.
Okay. Coming up in the next hour, Michael O'Rourke, Chief Market Strategist at Judge Trading. Looking forward to catching up with him. In your equity market right now on the S&P 500, elevated by 0.1%. Back-to-back gains for the month of August, the first time in yesterday's session off the back of gains on Friday. Jobs week begins right now, or rather begins a little bit later with job openings in America. Then it's on to ADP tomorrow, jobless claims, and on to payrolls on Friday. From New York City this morning, good morning.
The top names in business are on Bloomberg.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. Chairman Powell is trying to replicate what Paul Volcker did, to slay the inflation dragon.
Nobody covers business like Bloomberg, your global business authority.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
We agreed to establish a new commercial issues working group, a formal working group, which will involve U.S. and Chinese government officials, and very importantly, U.S. and Chinese commercial private sector representatives, as we seek solutions on trade and investment issues and to advance U.S. commercial interests in China.
That was U.S. Commerce Secretary Gina Raimondo speaking yesterday at a reception during her first day visiting Beijing, the first day of 4. That meeting going through Thursday for the Commerce Secretary. Plenty of news out there from China over the weekend. You know the rhythm of things by now. Easing, trying to support the economy and financial markets. They cut stamp duty on stock purchases for the first time since 2008. They've limited IPOs. They've been leaning on some funds to buy more than they sell. This morning, Tom, we're talking about maybe cutting the rates on deposits to try and juice this economy too. It's just attempt after attempt, day after day, week after week.
So full press by Gina Raimondo, our Secretary of Commerce there as well, Elizabeth Economy with the Council of Foreign Relations. And also our ambassador, Nicholas Burns, has been doing a very quiet, steadfast job under a lot of tension over there. But is this a lame duck trip? If I'm the Chinese, am I just like, okay, we'll take this in, but are we getting to the point where they have to wait for the election?
Based, Tom, on the amount of visits that are taking place by this administration to Beijing, based on those actions, it's pretty clear the objective is to maintain a relationship with China. And I'm sure they want some of these issues domestically resolved in an orderly fashion. Domestically, what they do on a campaign trail is totally different. And I think we know that based on the reporting of what President Biden said to potential donors when he said that this economy was a ticking time bomb, referred to the leadership and some of the individuals, the officials in the party as bad folks, and then going even further and saying when things get tough, Tom, bad folks do bad things. Now, if I was Chinese official right now, they're the kind of questions that I'd be asking of the Commerce Secretary. What kind of bad things do you think we're going to do?
And the other thing is I don't see specific negotiations on specific trade ideas, which is, of course, Raimondo's territory. But I get the visibility, John, and the imagery. I'm just not sure where we're going with this.
Well, where we're going is that they're trying to maintain a relationship without aggravating Beijing too much as they try to protect national security interests. This is what we have heard Raimondo and all of the other officials who have traveled to Beijing say. This is about national security. You are not trying to hold China back economically. And even Raimondo yesterday was saying that the U.S.'s aim here is not to decouple. They've had to switch language from decouple to de-risk.
To diversify.
To diversify. They've had to be so careful with how they navigate it, also knowing how sensitive the U.S. economy will be to any kind of slowdown we see in the Chinese economy. And you can't push it too far that you get caught up in the ripple effect afterward.
That's a tough enough needle to thread, Kayleigh. On top of that, then you've got to be hard on them at the same time simultaneously, TK, because that plays well domestically going into an election year. That's the challenge, to your point.
And that's the election year ballet here, and there's a domestic play. But I just don't see much getting done here other than photo moments, video moments as well. Let's get some brief on this, on the Pacific Rim, and also, of course, on the dollar. Win Thin is global head currency strategy, Brown Brothers Harriman, out of his Burma with a real visceral understanding of the Pacific Rim. If you are resilient dollar, Dr. Thin, what does it mean for the Pacific Rim? Can you imagine renminbi 7.29 yuan, dare I say a 740 or 750? Is that possible?
Absolutely, Tom. I think with the easing measures still being rolled out day by day, the interest rate differentials between the U.S. and China continue to move in the dollar's way. So yes, we're going to revisit those highs from October back around 733, I believe. And I can't rule out something close to 75, 7.5. I know it's sort of maybe premature, but at this point, I haven't used this term so many times in a long time, but they're really pushing on a string here with all these measures. And the last time I used this term so many times was back in the early 1990s, referring to Japan. And obviously the parallels are there. They are falling into a deflationary trap, a huge debt overhang, and these little measures that they're rolling out just aren't going to do it. They can't grow the way out of it. They're not growing 8, 9, 10% anymore. So some day of reckoning is coming, and I don't know when, but it will be coming.
Well, with your work at Columbia, you've been a great student of their international relations. Is this where a totalitarian regime essentially capitulates and changes direction politically?
Well, Tom, the policymakers in China have kind of tried to do it, both ways. They've tried to open up economically while limiting political freedoms, and that's been sort of the unsaid bargain between the policymakers in Beijing and the populace. But what's changed really over the last several years is that the economic prosperity is no longer being delivered. You know that there's youth unemployment is somewhere upwards of 20%. They stopped publishing that number. But there is a delicate balancing act that the policymakers are really trying to pull. They know they can't sort of grow the way out by issuing more debt, because that would just add the problem. So to me, the end game is something I see akin to what we saw in Japan, is that's huge debt restructuring, haircuts, bailouts. I mean, it's very painful. It can be done. I don't think it's ever been done on this scale before. And it's going to be, make no mistake, it's going to be very, very painful. But I think that's going to be happening in sometime in the next few years.
Well, what we're seeing just within the last few days, Win, is piecemeal action from China. Reports that they're looking for Chinese state-owned banks to cut deposit rates for the third time in a year, potentially cutting rates on existing mortgages as soon as today. John already mentioned the IPO restrictions they're looking at putting into place, asking entities to buy more than they are selling. It's just one thing after another, but does it all add up to enough? What more realistically can China do here to shore things up?
Well, they're doing what they can. But again, with debt to GDP around 300%, they just can't go back to the old way of rolling out huge debt-fueled stimulus. Again, they're pushing on a string at this point. That at the margin, all these things may add to a little bit of support, but really they're tackling the symptoms rather than the root cause, which I think is this huge debt overhang, overextended property sector that's feeding into the financial sector, right? That's where this whole thing sort of kind of comes unraveled is when the property sector stresses feed into the financial sector stresses. Again, I'm not trying to be like a doomsayer, but it's hard for me to figure out how they get out of this without a really painful sort of restructuring. And again, because it's so painful, they're going to put it off as long as they possible. No one wants to do this. And so they will continue to roll out these piecemeal measures until it becomes just too much to bear.
Well, and that's all.
Yeah, I'm sorry, go ahead.
That's all addressing the domestic problems, but what about the problems that more relate to the rest of the world in terms of exports, in terms of trade? And as we are talking about de-risking, diversifying, decoupling, whatever it may be, trying to get supply chains out of China, the trade flows around the world changing as well. On a longer term view, ultimately, what will that mean for the Chinese economy?
Well, even before these latest problems in the domestic, the President Xi had been trying to promote more domestic activity, more domestic consumption, and had really sort of taken their eye off the external sector. Part was, I think, due also to the U.S. measures under former President Trump with the trade wars, et cetera. And so it sort of came at the worst time that he switched to a more domestic-led strategy at the time when the domestic economy was really about to come under some serious stresses. Obviously, COVID had added to the pressures as well. So can they switch gears and go back to sort of an export-led recovery? It's not going to be that easy. The flip side of the coin is that most of its major trading partners, for instance, obviously the U.S., they've changed their supply chains already over the last several years, become less dependent on China. We saw that imports from Canada and Mexico have now overtaken those from China for the first time in decades. So it's not going to be that easy for China to sort of just flip a switch. I do think that President Xi will continue to sort of focus on this domestic-led recovery. And remember, think about the global growth outlook because it's quite poor right now. So all these things to me point to a sort of doubling down on this domestic-led focus, but unfortunately will lead to some sort of crisis in the coming years.
Winston, thank you, sir. Winston of Brown Brothers Harriman on China. The latest quote from Kit Jukes over at SocGen on China. I shared this with you yesterday. I think it's worth sharing again. Both Christine Lagarde and Jay Powell made it clear at Jackson Hole that they intend to see out the fight against inflation. There will be no changing of targets and no premature easing. But the earworm that I can't keep out is Mike Tyson's "everyone has a plan till they get punched in the mouth." And the headline of that piece yesterday, Tom, everything will be fine unless China punches us in the face.
There'll be others. I agree the mass here is China, but I'd also look at, say, South Africa ran through 20, pick any other currency pair, as Christopher Owen would as well. I totally take the point. There's a point where, you know what? Facts change, I change.
Equity futures right now on the S&P, just about positive on the S&P 500. Veronica Clark, economist at Citi, on why this Federal Reserve ain't done. That conversation up next.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Stocks are just about positive on the S&P 500 this Tuesday morning. We are elevated by not even 0.1%. Two-day winning streak, the longest of the month on the S&P 500, speaking to just how bad this month has been. The fact the S&P 500 is down about 3.4% in August, and that's the worst month of the year, speaks to how good 2023 has been.
It's not a correction. It's not even close. This is just noise. Look at the ginormous move we've had since October of last year.
That's what I just said.
I know, but
I didn't hear correction
we're
anywhere
down
in there.
3%. I don't mean you, John, but I mean out in the zeitgeist, people are thinking it's a crisis, it's a meltdown, it's a markdown.
Does it have the ingredients for one?
I think people are just trying to keep busy. No, I don't agree. We're down 4%. I got a VIX at 15.11 and I'm stressed. That's a victory lap VIX.
Let's get to the bond market, Tom.
Please.
I'll do this as calmly and as chilled and laid back as I possibly can.
Real yield's better.
Your 2-year at a beautiful 5%. Imagine the wonderful things you could do with that 5% yield. A 10-year, Tom, at 4.20.79. Yield's going absolutely nowhere, but that's okay. Things are fine. Is this helping?
It is. I mean, I got a triple leverage 13 months.
30-year.
You're doing pretty well.
A yield we haven't seen for a couple of decades. It's a beautiful thing. 4.28.60. And if you want a mortgage out there right now, TK, don't worry. I'll get you one with a 7 handle. You're going to be totally fine.
Charles Bailello with out there with the housing value, because rates have gone up. John, you've been great about this. How about this? In his calculations with Redfin, 641,000 is what you were buying X amount of months ago. Now you're buying 434,000. That's the reality. And imagine that taken over to rents.
It's
just like you go from a 4-bedroom to a 1.5 bedroom.
Tom, I said it yesterday. It's worth repeating. The distortions you're going to see in the economy, based on the rate policy of the last couple of years. Have we ever seen, in the space of 2 years, Tom, record low interest rates, and then the highest rate you've seen in 2 decades?
Well, this is the distortion.
In the space of 2 years.
Yes, I agree.
This is why this mortgage market is so screwed up.
It is, and we'll get the data today, Case Shiller, and it's a little bit delayed. It's not like the more recent data, but I agree with you. Off the pandemic, the proper phrase is it's screwed up.
Going to turn to the FX market.
Please, let's go.
Nice and calmly. This is a new time, Tom. It's a new mood for the FX market. 108 on euro dollar.
We go to 4 digits, 108.
108.12. Okay. Dollar yen, 146.64. Does this work for you?
It does. I'm just feeling
like bedtime reading.
It's peaceful.
Dollar yen, the call from Goldman, 155. TK, taking
John,
it back to the
what
1990s.
Like to order a 16-year-old to read the Scarlet Letter at gunpoint.
Where's this going?
You will read Nathaniel Hawthorne in the next 7 days.
Are you trying to explain your mood this morning?
My mood is based on...
The youngest isn't doing the homework.
Scarlet